Chapter 1, Part 1. Contains bookkeeping, accounting, statement of financial position, capital, assets, liabilities, accounting, recognition, financial statements. Bookkeeping. Bookkeeping is a process of detailed recording of all the financial transactions of the business. Accounting uses the bookkeeping records to prepare financial statements and regular intervals. Statement of financial position. The owner of the business also needs to know the financial position and regular intervals. So a statement of financial position is prepared. It shows what the business owns and what is owing to it, its assets, and what the business owes, its liabilities. The term financial statement is often used as a collective name for an income statement and a statement of financial position. Capital. When a person decides to start a business, will have to provide the necessary funds resources. It is often in the form of monetary fund, which will consist of buildings, motors, goods, and so on. Any resources provided by the owner of the business are known as capital. These represent the amount owed by the business to the owner of the business. Assets. Once the business is formed in capital total, the business will own the money or either items provided by the owner. Things owned by the business or owed to the business are regarded as the resources of the business or the assets of the business. Example: machinery used in production, building used in for office, computer used for accounting work. Liabilities. In addition to the owner, other people may also provide assets to the business. The amount owed by the business to these people is known as liabilities. Example: loan taken from bank. The accounting equation. Assets is equal to capital plus liabilities. The accounting equation. Assets is equal to capital plus liabilities. Like any other mathematical equation, the two sides of the equation will always be equal. The formula for this equation is assets is equal to capital plus liabilities. Capital is sometimes referred to as owner's equity. So the previous equation can also be written as assets is equal to owner's equity plus liabilities. Like any mathematical equation, the accounting equation can be used to find any one of the three elements of the other two are present. This equation illustrates that the assets of the business, the resources of the business, always equal to the assets and liabilities. Liabilities of capital of a business. The resources provided by the business standards. The assets represent how the resources are used with the business, and the liabilities and capital represent where the resources come from. The statement of financial position. The accounting equation is shown in the form of a statement of financial position. This shows the three elements of accounting equation: the assets, the liabilities. Double entry system of bookkeeping. Debit is equal to the major format of a ledger, two sides of a ledger, double entry records of assets and liabilities, double entry records for expenses and revenue, double entry records for points, balancing ledger accounts, double entry records for sales, goods sold and returns, inventory accounts, goods purchased for cash or check, goods purchased on credit. Trade credit accounts payable, goods sold on credit, cash for cash, check, goods sold on credit. Trade return, accounts receivable, purchase return, accounts sales return, return on inward carriage, inward carriage outward, 3-column running balance account, format of 3-column running balance account. Double entry system of bookkeeping. The business would find it impossible to prepare a statement of financial position after every single transaction. The day-to-day transactions are recorded in the books of the business using the double system of bookkeeping. The term double entry is used because the two aspects of a transaction, a giving and a receiving, are both recorded in the ledger. Debit is always equal to credit. Debit is equal to credit. In order to record the two aspects of every transaction is entered twice on the debit side of one account and on the credit side of another account. The account which is receiving or gaining the value is debited. The account which is giving the value is credited. Ledger. The business maintains a separate ledger, one for each type of asset, expense, liability, and income, and also for each individual debtor and creditor. Every transaction is recorded in the ledger account relating to the particular item or person. A ledger is traditionally a bound book where each account appears on a separate page. Over the years, the ledger has developed into a user page folder with separate sheets, each containing a ledger account, where recent developments have seen the introduction of computer file divided into separate ledger accounts. Format of ledger. This is the format of ledger. Two sides of a ledger, debit side and credit side. Ledger account is divided into two sections. This can be shown by a central vertical line. The left hand side is known as debit side and the right hand side is known as credit side. The term debit is usually abbreviated to DR and the credit is abbreviated to CR. On either side of the account, there are columns to record the date, details, and amount of each transaction. The folio number account column is used for reference purposes. The use of folio number is not required when answering questions. Double entry records for assets and liabilities. The ledger account is open for each type of asset and liability. Applying the double entry principle, every transaction is entered twice. The account which is receiving the money is debited. The account which is giving the money is credited. Double entry records for expenses and income. A ledger account is open for each type of expense and income. The same double entry principles apply to assets and liabilities are applied to expenses and income. The account which is receiving the money is debited and the account which is giving the money is credited. Double entry records put once. Whenever the owner of the business takes value from the business for any other use, this is known as drawing. This value may be in the form of money, non-current assets, or inventory, it is usual to open a drawings account to record the revenue so that the capital account does not have a large number of entries. Any drawings are debited in the drawings account to show the value going into that amount. Then the credit entry will be in the cover account gives the value. When money is withdrawn, either the bank or cash will be credited. When non-current asset is withdrawn, the appropriate non-current asset account will be created. When goods are withdrawn, the process account will be created. This is because these goods were originally purchased for resale and the amount of goods available for resale is reduced when goods are taken by the owner. At the end of the financial year, the total of the goods account is transferred to the capital account. This reduces the amount owed by the business. Balancing ledger accounts. At the end of each month, it is usual to balance any account of assets and liabilities which contain more than one entry. The balance is the difference between the two sides of account and represent the amount which is left in that account. Double entry record for sales, purchases, and returns. It is necessary to open an account to record goods which are purchased for resale and also an account to record goods which are sold by the business. Double entry records for sales, purchases, and returns. Well, these are actually the same goods coming into the business and going out of the business. It is necessary to have a separate account that the purchase will be a cost price and the sales and selling price. And purchase account and a sales account are either used rather than goods account. The same double entry principle applies to assets and liabilities are applied to purchase, sales, and returns. Inventory. An inventory account is only used to record the goods after the end of the financial year and not for day-to-day transactions. Goods purchased for cash or check. Whenever goods are purchased, the purchase account will be debited and the goods are coming into the business and the purchase account is received return. The double entry will be created in either the cash account or the bank account depending on whether the amount of paid in cash or check. Goods purchased on credit. It is common for business to buy on credit and pay for the goods at a later date rather than the time of purchase. The purchase account will be debited in the HR. Trade creditors account. The credit entry will be made in the account of the supplier of the goods to show the value coming from that person. The supplier of the goods is known as trade creditor or account payable. When a payment is made to the supplier, the bank account will be credited to show value going out of that account. And the amount of the supplier will be debited to show value going into that account. Goods sold for cash or check. Whenever goods are sold, the sales account will be created and the goods are going out of the business. And the sales account is giving value, giving out the value. The double entry will be debited in either the cash account or the bank account, depending on whether the amount of received is cash or a check. Goods sold on credit. Just as the business may purchase goods and pay for debit and later. It may also sell goods on credit. The sales account will be entered in the EMI. Debit entry will be made in the account of the customer. Accounts is going to whom the goods are sold to show the value going on to that person. Trade debtor or accounts receivable. The customer who bought the goods and credit is known as trade debtor. When the payment is received from the debtor, the bank or cash account will be debited to show value coming into that account, and the account of the debtor will be debited to show value going out of that account. Purchase return or return out of goods or goods. Sometimes goods which have been purchased have to be returned to the supplier. This may be faulty, damaged, or not ordered. These goods are known as purchase returns or return out. A special account known as purchase returns account or return out account is open and any returns are collected in discount to show the value. The debit entry will be made in the account of the supplier. The goods are being returned to show the value to the person. Sales return or returning out of goods. Similarly, a customer may bring goods to the business. These goods are known as sales return or returning goods. An account known as sales return account or returning over only returns are debited to discount to show the value coming in. The credit entry will remain in the account of the customer who entered the good to show the value coming to that person. Double entry records for carriage invoice and carriage outsource. The term carriage invoice refers to the cost of carrying transportation goods. Carriage invoice is part of the cost of purchase invoice, which occurs when the business has to pay for goods it has purchased to be delivered to its premises. Double entry refers to carriage invoice and carriage outwards. Carriage outward is a selling expense that occurs when the business pays for goods to be delivered to the customer's premises. It is important that these two expenses are treated separately in the accounts. Carriage inward, carriage outward. Goods cost, carriage the cost of transporting goods. Carriage inward the cost of bringing the goods to the business, and carriage outward the cost of delivering the goods to the customer. We call them running balance accounts. The ledger account present itself are having a traditional form. This is also known as the T account. There is another method of presenting ledger account. This is commonly used in company present accounts, which is known as 3-column running balance format. The form of presentation is with one column is for the date, detail, and figure, and has 3 money columns. So you said whatever one for date and one for balance each transaction. The advantage of this method is that it shows the balance of that account after every transaction. The account of the money is involves with extra calculation errors. See part 1. Contains a trial balance format of a trial balance. The first is balance trial balance. Balance trial balance, error of provision, error of complete error of provision, error of compensating errors. A trial balance. It is important to remember that the trial balance is not a part of the regulatory system. It is simply a list of balances. If the ledger accounts are balanced complete, then a trial balance can also be drawn from the trial balance. The trial balance should be added with the term trial balance along with the date on which it was prepared. Format of trial balance. The purpose of a trial balance. The trial balance can have locating of multiple balance. However, the balancing of the trial balance is not proof that entries in the ledger account of multiple balance. The trial balance is useful in preparing financial statements. Trial balance analysis. The trial balance analysis. If the trial balance goes to balance, the trial balance goes to balance, the obvious that an error has been made somewhere. This may be an error of addition within the trial balance, an error of addition within the ledger accounts. Entering a different figure on the page presented on the page making a simple for a transaction rather than entering a transaction twice on the same ledger. Balance trial balance. And balance trial balance is the total of the balances equal to the total of the balances. It does not imply that the double entry is error. The trial balance will still have balance if any of the following errors are made. Error of provision. This occurs when a transaction is entered in the correct amount of the credit side, but in the wrong amount of the savings. Cash received from margin credit to margin customer. Error of complete yields. This occurs when the correct amount is entered in the correct account, but the entry has been put on wrong side of the cash balance debited to cash account and credited to wrong side. Error of omission. This occurs when a transaction has been completely omitted from the account, whether a debit entry or a credit entry. Payment of business not entered in use. Error of origin. This occurs when a incorrect figure is used in the transaction was entered in the market cost. The debit entry is therefore incorrect. Goods of $1,000 but recorded as $1. Error of principal. This occurs when a transaction is entered into the correct amount on the website within the wrong line. Motor expenses debited to the motor agent. Compensating error. These occur on 2 or more accounts. Errors cancel out each other. Purchases account under added by $1 and expenses over added by $1. Recommended books for reference. Chapter 5, Part 1. Contents: the petty cash book, the interest system, advantages, the layout of the petty cash book or interest system. The petty cash book is used to record loan value, petty cash book, interest rate, maintaining a petty cash book. This reduces the number of entries. The interest system. Petty cash book is used to record loan value, cash payment. The interest system of petty cash is where the amount spent each period is stored so that the petty cashier starts each period with the same amount. Advantages of interest system. The interest system mostly petty cash books are maintained using the interest system. Under this system, the petty cashier starts each period with a fixed amount of loan. This is known as interest amount or loan. During the period, payments are made out of the cash and recorded in the petty cash. At the end of the period after the petty cash, which is balance, the chief cashier will call the petty cash. Enough cash to restore the balance to the amount of interest. The petty cashier therefore starts his payment with the amount of cash. Under this system, the chief cashier is aware of exactly how much the petty cash is being spent. This means that the petty cash expenditure can the amount of interest system can be registered in the schemes or not. The system cannot stand to reduce that. The layout of petty cash. The layout of petty cash. The petty cash basically represents a ledger account with several columns and fields. These are known as analysis columns and are used to do the column is used for each of the types of expense for the cash. Instead of folio column, we can say there is a column for the column. The number of columns and the types of expenses. Format of petty cash. So you can see the format. So details, total receipt, details, total of analysis columns. So there are various expenses columns like convenience column. So this will be convenience column. This will be like small expenses, supply expenses. This may be like hot question, small payments. Chapter 6, Part 1. In this lesson, we will discuss about invoice, trade discount, cash discount versus trade discount, statement of checks or paying receipt. Invoice. When a business sells goods on credit, we issue an invoice to the purchaser. Each business has its own style of invoice. They all contain the following information: the name and address of the supplier, the name and address of the customer, the date, full details, quantities, and prices of the goods supplied. Trade discount. Sometimes the supplier allows the customer trade discount. This is a reduction in the price of the goods. The rate of the discount often increases according to the quantity purchased. So encouraging customers to buy in bulk. It is also given to businesses in the same rate. Such businesses will not be prepared to pay the full rate as they need to make a profit in this business. Cash discount versus trade discount. It is important to distinguish between cash discount and trade discount. Trade discount is shown as a deduction on the invoice. Cash discount is not shown as a deduction for the invoice, as it is only allowed if the invoice is paid within a set time limit. Debit note. A debit note is a document issued by a purchaser of goods or credit to request a reduction in the invoice receipt. Credit note. A credit note is a document issued by a seller of goods or credit to notify of reduction in the invoice previously issued. Statement of account. At the end of each month, the supplier will usually issue each customer with a statement of account. This is a summary of the transactions for the month. The style of the statement of account may vary, but they all contain the following: the name and address of the supplier, the name and address of the customer, the date, the balance owing at the start of the period, invoices and credit notes, payment received, unit cash dispense allowed, the balance owing at the end of the period. Checks or e-pay. Checks many accounts are paid payments or check. Other methods of payment through the banking system are paid transfers and stamp payments. The check is a written order to a bank to pay a stated sum of money to the person or business provider. A book of pre-printed checks is issued by the bank and the customer is required to complete the necessary details of it. amount I'm paying. The person or business to whom the money is paid. The receipt. The receipt is a written amount of money, so it acts as a proof of payment. Since the check passes through the bank, it will act as a receipt. So many business. Chapter 7, Part 1. Contains books of primary revenue, books of primary the list, sales journal, sales return journal, purchase journal, purchase return journal. Books of primary business as usual. Use books of primary record goods sold and goods purchased, sales returns and purchase returns. Books of primary also known as books of personality or subsidiary returns. The name of business has arisen because all transactions should be recorded in the name of business before they are entered in the ledger. Books of primary the list. The books of primary are cash book, petty cash book, sales journal, purchase journal, sales return journal, purchase return journal, general journal. Sales journal. The sales journal is the list of the names of businesses which do sales work. The value of the sales and dates on which sales were made. The sales journal is sometimes called the sales book of the sales journal. This journal is written up using copies of the images sent to the customer. The entries are summarized as follows. When goods are sold on credit, enter the date, customer name, and invoice total in the sales value. Debit the customer's account in the sales ledger with the invoice total. At the end of the month, credit the sales account in the nominal ledger of the sales journal. This will now form the double entry for all individual ledger entries in the sales ledger. Sales returns journal. The sales returns journal is a list of name of the businesses, the value of goods returned, and the goods on which the sale returns were made. The sales returns journal is also known as the sales return book or the returns inward book or returns inward journal. This journal is written up using copies of the credit notes sent to the customer. The entries are summarized as follows. When goods are returned by a credit customer, enter the date, credit customer name, and credit note total in sales. Credit the customer's account in the sales ledger with the credit note total. At the end of the month, debit the sales return account in the nominal ledger in the sales account. This will now form the double entry for all individual credit entries in the sales ledger. Purchase journal. The purchase journal is a list of names of businesses for which credit purchases were made. The value of the purchases and the dates on which purchases were made. The purchase journal is also called the purchase book or the purchase statement. This journal is written up using the invoices received from suppliers. The entries are summarized as follows. When goods are purchased or credit, enter the date, supplier name, and invoice total in the purchases. Credit the supplier's account in the purchases ledger with the invoice total. At the end of the month, debit the purchase account in the nominal ledger with the purchases total. This will now form the double entry for all individual credit entries in the purchases ledger. Purchase returns journal. The purchases returns journal is a list of names of businesses, the value of goods returned, and the date on which returns were made. The purchases returns journal is also known as purchases return book of the returns or book or returns record journal. This journal is written up using credit note received from suppliers. The entries are summarized as follows. When goods are returned to a customer, credit supplier, enter the credit supplier name and the credit note total in the purchases return journal. Debit the supplier's account in the purchases ledger with the credit note. At the end of the month, create the purchase returns account in the nominal ledger with the purchases return journal. This will now form the double entry for all individual entries in the purchases ledger. Chapter 8, Part 1. In this lesson, we will discuss about an income statement, a statement of financial position, financial statement, statement section of financial statement, cost of sales, purchases, trading account, profit and loss statement, statement, housing, comprehensive statement, income statement of business. An income statement. Income statement consists of two sections. A trading section in which the gross profit of the business is calculated. A profit section in which the profit of the business is calculated. The trading section same way it should be presented line by line. This is the pattern, this is the format. Profit and loss section of the income statement. The profit and loss section of the income statement consists of profit and losses, gains and expenses. Its purpose is to calculate the amount of profit after all incoming expenses and other items. It is known as the profit for the year. The formula for calculating profit for the year is profit for the year is minus expenses. Profit and loss section of the income statement. This is a format of profit and loss section. Horizontal format is the trading section of the income statement. Section of the horizontal or the vertical format. Using the horizontal format, the gross profit and the credit side and the expense. The difference between the two sides equals the profit for the year. The credit side is the largest or the loss related to the debit side is the largest. Comprehensive income statement. This is the format of comprehensive income statement. Gross profit, profit from operations and profit from execution. Income statement of the service business. Service business such as an accountant, an insurance company, travel agent, the hairdresser, and so on. As at the end of the financial year, these businesses still need to prepare financial statements. However, the technical compensation and income statement is not prepared as accounts are not and so on. Only the profit and loss section of the income statement and the statement of financial position. In the income statement, all the items are sales, assessments, finance commission, expenses are written. The statement of financial position is exactly the same as the statement of financial position. Chapter 9, Part 1. Financial statements part 1. Contents. Statement of financial positions. Components of financial position. Assets, tangible, non-current assets, intangible, non-current assets. Current assets, components of financial position. Liabilities, capital, non-current liabilities, current liabilities. The statement of financial position. The statement of financial position shows the assets of the business, what the business owns and what is owed to the business, and the liabilities of the business, what the business owes on a certain day. The assets show how the resources are used and the liabilities show that they are. Chapter 10, Part 1, Accounting Principles, Conventions and Assumptions. Contains accounting principles, business ability concept, consistency, duality, growth concept, historical concept, matching principle, materiality concept, money measurement, tolerance, realization, international accounting standards, comparability, relevance, reliability, understanding, capital expenditure, revenue expenditure, capital receipt, revenue receipt, accounting principles. Accounting principles are sometimes referred to as concepts and conventions. Concept is a rule is subject of how the financial activities of a business are. The convention is a separate business entity. The business entity principle is also known as accounting entity. The personal assets are known to the person is do not appear in the accounting record. The accounting records relate to the accounting assets. The liabilities is the money spent with the everything is recorded from the viewpoint of there is transaction concerning both the business and its owner and it is recorded. When the owner enters this capital to the business is credited to the capital account. The share of funds coming to the owner. The capital account was credited as by the business to the owner. When the owner is drawn for the business equivalently to show the value to the owner. So the uses the amount of consistency. There are some areas of accounting which are of for example, there are several different ways to calculate the depreciation of assets. The return of method is available, the one with the most realistic outcome. Once a method has been selected, the method has been used consistently. This is known as the consistency. This is not the comparison of the financial result to another and the cost of particular companies. There may be a good reason why it is necessary to change the method of valuing in such a situation. Let's say duality. The principle of duality is also referred to as the dual aspect principle. Every transaction has two aspects to giving and receiving. The term duality is used to describe how these two aspects of transaction are common. Going principle. The accounting record of business are always this means that it is believed that the business will come in by any significant amount is the whole concept. This continuity is the non-current assets showing the state of the which is the original costless difference. Inventory will appear at the lower of cost of the trade. If it is expected that the business will cease to operate in the asset, then the state of the assets will be shown and the expected sales value which are more than the situation. Historic cost. The historic cost principle requires that all assets and expenses are initially recorded. Is going to lead to the cost is an impact and like this principle is a difficult to make comparisons because of the effect of image. Sometimes it is necessary to allow non-current assets are more realistic. So the cost is very difficult. Matching. The matching principle is also referred to as the accrual principle. This is a distinction of the remuneration principle to the revenue of accounting period is not the hospital season, the time of hospital season. The figure shown in the income statement relate to the period of bank account. Whether or not anything has this means that it's more important to combine sales expenses and so on. Material principle applies to items of very low value. Items which are not material, which are not worth calling the sequence. Other principles can be ignored in this time, cost, and how the concepts will or by anywhere to do. For example, pocket capital purchase profit is 50 currency. Part of this value is lost each year. Laptop computer is another tool for talk. When you click, looking for a small folder. The large business to reside the non-current assets often like the non-current will be regarded as recharge business. Small business may have a much lower value. This principle is also applied to handling smaller businesses, known as general businesses and businesses rather than for office businesses like cloud. Utility is also applied when the total cost of money measure. The money measurement principle is that the only information is from the money is a representation of traditional law. It does not relate to personal life. There are many aspects of the business which are not measured. Other than that, the goal of the business, a good manager, because of stock because all the things that they will not appear in the account. The value will not appear. In a similar way, the amount of value for the business as well as this cannot be measured. Prudence. The prudence principle is also known as the principle of control. This principle ensures that the amount of present against the future of the future. However, the excesses of faith will not allow the or the deliberate of the in short, will not allow content the phrase specificity of is often used to discuss the principle of profit should only be recognized so that the profit of the not only less. Prudence is a very important. If the situation arises where a plan for account principle is not only then the principle of prudence applies. For example, under the realization principle, profit is earned and this actually is if the customer goes to pay after the principle of prudence can be applied on the realization. Realization principle applies to the important and not the common profit. This means that revenue only requires perhaps an obligation an order is paid to a customer, no sequence of profit. Profit is regarded as actually challenge. This is the same even in the which are no longer in a customer does not pay for international accounting. International accounting ensure that financial statements are compared in this all of them enter in the objective of the standards are to ensure the values of financial statements. The quality of information that can financial statements. This quality of information can be built in terms of four types. Comparability, reliance, reliability, and trust. Comparability. The information contained in financial statements that is compared with similar or at another point in time. It is also useful to be able to compare the information with similar information. In order to make comparisons, it is necessary to be aware of policy. Any changes in these policies and methods are important to be able to identify in the financial statements and information related to other relevance. Financial statements provide information about the financial performance. This can be used as the basis for financial decisions. It is important to know information not only required. It is also important to the information related to this means that it can be used to compare market expectations and also to inform the way market expectations. Reliability. Information provided in financial statements and reliability is capable of from the users and online knowledge. This is the goal of the interpretation of the last pages. The very simple caution apply to services. understanding the financial statements can be understood with the use of the currency. This depends often on the gravity of the information or transfer of the statement. It is normally assumed that users of financial statements are able to and study the our information of the decision that it could different parameters. Capital expenditure. Capital expenditure is management of uncurrent assets. This is the solid cost of current cost of current non-current assets. These costs will appear in non-current assets. They should not be charged as expense in the value of non-current assets often decreases because of this cost. Revenue expenditure is means and the cost of payment also include the cost of purchase to the purpose of this cost will be given with these two types of expenditures are with still that we are also looking at the business condition of due to the income to the profit for the increase and the statement and the capital also increase. Capital receipt of person will receive from this is like the balance sheet of the receipt of funds and receipt of capital expenditure is investment of the revenue expenditure is investment of the capital receipt is only received the capital receipt how a computer revenue receipts. The revenue receipt is received by this include the receipt of such as rent receipt. Because these arise from the normal trade to inventory valuation. Inventory valuation is necessary to receive the valuation. Inventory are always valued with the cost of inventory. This is the application of principle of the cost of inventory is actually the net realizable value is estimated less the cost of commodity from even the cost of lower than the increasing value. Now, the release of that will be because of changing based on that. This situation is value cost. Chapter 11, part 1, other payables and receivables. Other payables and receivables. This lesson we are going to discuss here and respect to combined opening back. Here it is not necessary to enter this. And the kind of such as only items related to the particular income statement is prepared for the period of time. There is no time to cover the practical application of the practical application of this is the profit or loss for more simple data relating to the particular. This is illustrated in the example. Good expense. What is an amount due in an accounting during the should represent the expense for the amount this means that any amount to due but unpaid at the end of the financial year to the the expense account will now show a balance of the complete and the balance represents an amount to be included as a balance. Prepaid expenses. Prepayment is an amount that is very amount. As with the total expenses, any amount paid equal to the amount paid. Complete the for balance. There might this must be considered as capital. Applied expenses. The same principle are used for the balance. Once again, the last any amount is the income related to the will now share the balance as the business this must be considered as capital. Accounting for depreciation, chapter 12. Depreciation. So in this lesson, we are going to learn about depreciation, the whole concepts of depreciation, methods of calculating depreciation, straight line method, advantages and disadvantages, reducing balance method, revaluation method of depreciation, recording depreciation in the ledger, accounting depreciation in income statements, account depreciation in position statement, depreciation manufacturing accounts, then in book value, depreciation appears twice, disposal of non-current assets. Depreciation. Depreciation is an estimate of the loss on value of the non-current asset over its expected working life.
Most of the non-current assets of the business lose value over a period of time that are used in the business. If the accounting records continue to show these assets at their cost prices, then the accounts will provide misleading information. It is therefore necessary to record an estimate of the loss in value. The records can only show an estimate of the loss in value of the non-current asset because of depreciation. The exact amount will only be known when the asset is disposed or sold. Buildings depreciate over time, but land does not usually lose value unless it is something like a well or mine when value is removed from the land. The whole concept of depreciation. The purchase of non-current asset is capital expenditure. The cost of non-current asset is not charged as expense in the year of purchase. It benefits the business for several years. Matching the capital expenditure against the sales, it has helped the business to earn is done by annual charge for depreciation. This means that the cost of non-current asset is spread over the years, which benefit from the use of that asset. The depreciation for the year is included in income expenses in the income statement. So the profit for the year is not overstated. This is an application of the principle of when the profit is overstated, the owner of the business may be tempted to withdraw more cash than the business can actually afford. The principle of prudence is also applied in the statement of financial position as the non-current assets are recorded figure less than the cost price. This is known as the value or the redundant value. This overrides the historic cost principle as it ensures that the non-current assets are shown as more realistic values. Causes of depreciation. The four main causes of depreciation are physical deterioration, economic reasons, passage of time and depletion, physical deterioration. This is the result of wear and tear due to the normal usage of the non-current asset. It can also be because the asset falls into poor physical state due to rust, or decay, and so on. Economic reasons. The non-current asset may become inadequate as it can no longer meet the needs of the business. It can also be because the non-current asset has become obsolete as newer and more efficient assets are now. Passage of time. This arises when where a non-current asset, for example, a lease has fixed life of a set number of years. Depletion. This arises in connection with non-current assets such as wells and mines. The worth of the asset is taken from the asset. Methods of calculating depreciation. There are several methods used to calculate the estimated loss in value of non-current assets. Different types of non-current assets are often depreciated using the method selected should be the one which spreads the cost of the asset as quickly as possible by a period of time. Once a method has been selected for a particular non-current asset, it should be applied each year. This is an application of the principle of consistency. In practice, many factors are considered before the depreciation method is selected. These are: how long is the asset expected to last, how much will the asset be sold for when it is out of use, how can the benefits from the use of the assets be achieved. These are the three main reasons for depreciation. Straight line method, reducing balance method. Straight line method of depreciation is also known as fixed installment method or cost. The formula used for calculating the annual depreciation is cost of asset over number of expected years of use. This expresses the annual depreciation as an amount of money. The answer to this formula expresses the percentage of total cost. This method applies the same amount of depreciation on the same percentage of the cost per each year. The value of the asset can fall to nil if there is no residual value. This method is used where each year is expected to benefit equally from the use of the asset. Advantages and disadvantages. Advantages of the straight line method of depreciation. It is relatively easy to calculate. It is useful when a non-current asset provides equal benefit for each year of its useful life. Disadvantage of straight line method of depreciation. It is necessary to estimate the useful life and the residual value of non-current asset. It ignores the actual rate at which the non-current asset will lose value. Reducing balance method. Reducing balance method of depreciation. The way implies the amount of depreciation reduces each year. The same percentage rate is applied, but it is calculated on a different value each year. At the end of the first year, the depreciation for the year is calculated on the cost of the asset. The depreciation of the following year is calculated on the cost of the asset less the depreciation previously written on. The figure of cost plus depreciation is known as the net book value or return value of the asset. The value of the asset can never fail. The depreciation on all are calculated as a percentage of the net book value. This method is used when the greater benefit from the use of assets is decaying in the early years of life. Assets depreciated by this method often have a low maintenance cost in the early years. This method is often used for those assets which quickly become out of date because of advanced technological progress. Any residual value is taken into consideration when the percentage rate is selected. Advantages and disadvantages. Advantages of the reducing balance method of depreciation. as cost of living. It is useful for those non-current assets where greater benefits are gained in the early years of usage. Disadvantages of the reducing value and on depreciation. The depreciation has to be recalculated each year. The depreciation charge against profit is referred in the early years of non-current assets. Revaluation method of depreciation. This method is used when where it is not practical or it is difficult to keep detailed records of types of non-current assets. If detailed records are not available, the instrument then using online method of depreciation cannot be calculated. Small items of equipment used in offices and laboratories, packing cases, loose space, etc. are usually depreciated using revaluation method, as no detailed records are kept for these assets. The assets are valued at the end of each financial year. This value is compared with the value at the end of previous financial year or with the cost of the issue. If it is the first year of ownership, the amount by which the value of the asset has fallen in the depreciation profit. Advantages and disadvantages. Advantages of the revaluation method of depreciation. It is not necessary to estimate the useful life and display value of the current asset. No complex calculations are required. Disadvantages of revaluation method of depreciation. The non-current asset has to be revaluated at the each year. The valuation will be based on personal opinion. Recording depreciation in the ledger. Recording depreciation using the statement method and reducing value. Procedure for entering depreciation can be used in the method and reducing value. Feature of non-current asset as well as accounts and account of for recording the cost of the depreciation, account for recording the depreciation, the provision for depreciation and asset account. The asset account always has a debit balance and the provision for depreciation always has a credit balance. These two balances must always be considered together. The difference between the balances of these accounts represent the net value of the asset. Recording depreciation in the financial statements. Recording depreciation in the income statement. The depreciation for the year for which at least above asset is credited to provision for depreciation in the amount and is debited to the income statement. This reduces the business profit. As depreciation is non-monetary expense, it is usually shown after the monetary expenses in the income statement. Depreciation in manufacturing business. So the business is a manufacturing business. Depreciation of the sales in manufacturing process will be debited to manufacturing account rather than income statement. This increases the cost of manufacturing, which in turn reduces the profit for the reducing recording depreciation in the statement of financial position. It is usual to show the total cost of each type of non-current asset less the total depreciation return now for the date of statement of financial position referred to as accumulated depreciation or depreciation rate. The difference between these figures is the net value. Depreciation appears twice. The financial statements are prepared from a trial balance and its accompanying notes. In the trial balance, the balances on assets account are shown on the debit column and the balances provision for are shown in the credit column. One of the notes will indicate the depreciation of the charged financial year. The depreciation for the year will appear twice in the financial statement, which is an expense in the income statement and it is included in the statement of financial position and part of the provision for depreciation. The depreciation for the year is added to the balance shown in the trial balance. Disposal of non-current assets. Because the purchase of non-current asset is capital expenditure, it is recorded in an account for the current asset rather than in purchase account. When a non-current asset is sold, it is capital asset and is recorded in special account known as disposal of non-current asset account rather than in the sales account. When a non-current asset is sold or disposed, it must be removed from the ledger account. The cost of the asset and the depreciation of the asset are removed from the asset account and the provision for depreciation account transferred to the disposal account. The proceeds of sale are also entered into this account. It is quite likely that this account will not vary. This is because the depreciation was only an estimate on the loss of the loss in value. Only when the asset is sold can the residual actual loss in value be calculated. Difference on the disposal account represents already loss in disposal. When the actual depreciation proved to be more than the estimate or a profit in disposal, when the actual depreciation proved to be less than the estimate. Chapter 13, Part 1, Irrecoverable Debts and Provision. In this chapter, we discuss irrecoverable debts rating of irrecoverable assets with provision for repairs, estimation, creating, adjusting a provision for repairs. Irrecoverable debt. The goods are sold on credit. The customer is able to pay for the goods at the level. It is always said that the customer may not pay for those goods. And irrecoverable debt is an amount of credit not be paid for the customer. This may be because the customer has disappeared, has gone out of business, or because he is unable to pay. If all reasonable steps to obtain payment are taken, the debt is taken. The account of customer is going to transfer the account. At the end of the year, the total of the irrecoverable debts account is transferred to the interest rate where it is divided by the Writing up. Writing up irregularities is an example of application of the principle of limits. If the debt cannot be regarded as an asset, it is not, so that the assets are not yours. The amount of the irregularity is regarded as a loss from the customer is included in the income statement level of the problem of the reverse. Recovery debts is a norm. It is written off may be recovered if this customer pays some or all of as the amount of the customer has been through the amount received is utility and credited to the debts recovered account. An alternative method is to restrict the debt by creating the debts recovered account and limiting the customer the amount they previously owed. The amount received would then be ensured by limiting the cash and creating the customer. The advantage of this method is that all the transactions relating to the customer appear in the account. Year end adjustment. At the end of the year, the total of the debts recovered account can either be transferred to the income statement as income for the year or transferred to the credit of the recompense account, where it is the reason that the debts is not being paid in the year. Reducing the possibility of irregularities. The only certain way of avoiding irregularities is not to sell goods and goods. In practice, this is not always an option. All possible steps will be taken to avoid irregularities. Before another credit is in the customer, credit preferences should be and from a customer bank and doesn't use a credit limit is usually for this customer because it's an upper income and the customer can move in this credit limit can be reviewed periodically. The establishment of credit limit and the later monitoring of the customers on the business credit. Invoices and maintenance statements account should be issued promptly. The sales ledger account should be carefully monitored. Any overdue account should be investigated and customers contacted to the CVs and consequences. No further goods should be supplied until the amount due is paid. More extreme way must take legal action on the customer. At the same time, the amount of debt is too small to justify costly legal proceedings. Provision for doubtful debts. The provision for doubtful debts is an estimate of the amount of the business will be in financial year. At the end of the financial year, the business is credit and estimate the amount which will be lost because of the debt. This ensures that the profit for the year is not overstated the amount of debt received in the statement at a realistic level. This is an application of the principle of debt. By maintaining the provision for doubtful debts, the business also observes the principle of debt. The amount of sales for the business is unlikely to be paid rather than expense of the year in which those sales are made rather than the expense of the year in which debt is actually estimation. In order to make a provision for doubtful debts, it is necessary to estimate the amount of doubtful debts. The amount of provision will be established by looking at each individual credit customers account estimating which will not be estimating on the basis of past experience the percentage of total amount of education. Considering the length of time that's outstanding the needs of an agency, the provision for a higher percentage may be made on order longer the greater the risk. Creating a provision for doubtful debts. Once it is decided to create a provision for doubtful debts and the amount of percentage that is decided, this can be recorded in the books. These entries are made at the end of the financial year. The entries are summarized as follows. Debit the income statement with the income provision for doubtful debts. In the statement of financial position, deduct the balances on the provision for doubtful debts and account for the trade receipts. Adjusting a provision for doubtful debts. In future years, it will be decided to include the provision for doubtful debts in the same percentage. If the amount owing has increased, the provision will be increased as well. So the provision, original provision for doubtful debt was different from the provision that has been facilitated. We decided the sum to change. This adjustment for the provision of doubtful debt is made at the end of the financial year. The entries are sometimes as follows. Debit the provision for doubtful debt along with the next provision is carried on as the balance. Transfer the difference of the provision from doubtful debt to the statement. In the statement of financial position, debit the balance on the provision for doubtful debt account. Debit provision from trade receipts. Chapter 15, Part 1. All journal entries. Opening journal entries. As the name says, opening journal entries are made with business starts or business first schemes accounting. An opening journal entry is the assets and the definition of the balance score and the capital of the business purchase and sale of non-current assets. As the purchase and sale of non-current assets are not recorded in they should be entered in the general ledger before being posted to the ledger. After the general ledger, the transaction is posted to the public ledger. Non-regular transactions, as explained earlier, any transactions should not be recorded in the these often consist of transactions which are not recurring for regularly and year-end transfers to members. Transaction is posted to the appropriate business after business. Correction of errors. The errors within the recording of day-to-day transactions can be user not using the errors which are not shown to the driver. There are 10 types of errors, 6 types of errors which can be made when you not using the driver. Yeah, error of commission, error of completeness, error of municipal compound. Such errors are discovered we should discuss them in some error is affected some errors may affect the driver if the errors are not affected the driver this is regarded as a temporary accounting differences in the driver. The suspense account. The suspense account ensures the balance of balance and not drop financial statements to be. It also allows the benefit, raising liquidity and ensure that all of the close the suspense account. As the errors are found, they are corrected and the appropriate entries are made in the account. When all the errors will be found in the suspense account, balance the suspense account. All the errors are affected with the management of the transaction are discovered. The suspense account will not be closed. The balance the minimum of suspense account indicated the errors and errors in the account. Effect on profit of writing. So errors discussed after the comes to writing. Any corrections made by items appearing in the trading section of items both the gross profit and profit. Any corrections made by items appearing in the profit and loss. Effect on statement of financial condition. If errors are discovered and corrected after the statement of financial condition, the profit or revenue have been corrected, this will affect the balance. Whether items not significantly Chapter 16, Part 1, Control Accounts. Control Accounts. In this chapter, we will discuss all about control accounts. Sales ledger, control account, office ledger, control account, items, contents of control accounts, sources of control accounts, items included and excluded in control accounts, balances. Control accounts. Control accounts are also known as total accounts. The balance space the balance of the error cannot be necessary to check all the accounts. This can take a considerable amount of time. The checking process can be speeded up with control account versus which contain the accounts of the class and control account for the purchase which contain the accounts of the class. These accounts act as a check on the individual accounts within these ledgers. Like the trial balance, these accounts can be checked arithmetically. Errors such as omission, corruption, not to be sales ledger control account. The sales ledger control account is an account summary in all the accounts of the sales. Purchase ledger control account. Purchase ledger control account is an account summary in all the accounts of trade. Advantages of control accounts. There is a set of accounting records in the advantages of preparing these accounts are as follows. You can assist in locating errors when transactions. They are good. The arithmetical accuracy. Ledgers that include the balances on these accounts are recorded as equal to the total of the trade receivables and the total of the trade payables. So this information is available in the draft financial statements can be prepared with the balances provided to the accounts. They have to reduce fraud and the control accounts are prepared not may involve in this particular business. They provide a summary of the transactions between the trade receivables and the trade payables for each transaction. Excluded accounts. The sales ledger account is a summary of the accounts of trade customers to receipts and will not include items such as flash sales and provision for activities. Sales ledger control account. Sales ledger control This is also referred to as trade receivables. This account resembles the account of the trade customer. But instead of containing transactions and replacement customer, it contains transactions related to all the debtors. The typical sales ledger control account is shown. Sales ledger control account. So on the debit side, you can see the balance is there, sales, for this check, bank or check payments, receipt, interest charge. So on the credit side, sales returns, cash, discount allowed to purchase. And this account acts as which account only customers prepare it for customers. Here the sales ledger account will be the control account is prepared for the accounts. The information to prepare a sales ledger control account is source of information as source of information. For sales it is sales income it is sales income. Receipt from credit customer, discount allowed to credit customer, discount. So different to credit customers we can document that. Irregularities with no interest charge only account from that. The sales ledger control amount is not on the end of the balance. The total of the balance is not credit customers function that is the balance. Then it indicates that there is an error in one of the customers account or an error in the control account. So public checks are purchase ledger control. Purchase ledger control is also includes total trade credits. This amount resembles the amount of credit sector, but instead of containing transactions, consider this one percent of this transactions. Typical purchase ledger control account is shown. So this is the format of purchase ledger control account. So you can see purchase returns on the debit side, cash, and expenses. So on the credit side, it's balance problem, purchase, interest charge. So the accounts are similar to the cases that we have and see the check on the individual payment sequence account and prepare the information to prepare a purchase ledger account is the source of information as an purchases are often for purchase payment to credit segment discount receipt interest charge on only account like the sales control account purchase the control account is one of the total of the balances on all the credit processes to the balances in the control account. If they differ, it indicates that there is an error in the numbers what is not used. The account in the sales and purchase ledger are not used to provide information to control account what is included in this? Sales ledger account is a summary of the accounts of credit customers trade receivables, so you not include items which do not appear in the account of credit customers, such as cashes and revenue. So purchase ledger account is a summary of the accounts of credit customers trade receivables, so you not include items which do not appear in the accounts of credit customers, such as cash purchases. Balances on goods. Occasionally, credit customers account will show a credit balance. This may occur due to an overbooking to the customer. The customer returning goods after paying the account. The customer paying the amount for the goods. Time discount on before paying the account. In the sales ledger control, if you need to keep any credit balances separate from the debit balance, the control account will look for only balances. The debit balance, the credit customers are more, and the more unusual credit balance representing money on the credit customers. Any credit balance is linked on the debit side and the amount carried over the account can be balance. Balances on both sides. In a similar way, debit surplus account can be a debit balance. This method will do a more to the similar evaluation is similar on the paper. Take the item and not for discount on the as in the sales ledger control account, the debit balance and the credit balances are shown separately in the purchase ledger control account. The purchase ledger control account will therefore have two balances: the usual credit balance representing credit surplus and non-usual debit balance representing by credit surplus. Any balance, debit balance is entered on the credit side of the control account and carried on in the account can be contra entries. Contra entries in control accounts. Contra entries are also known as interledger transfers as accounts. It may happen that a business sells goods to another business and also buy different goods from the business This means that there will be two ledger accounts for the business, one in the sales ledger and another in the purchase ledger. Rather than each business sending the other a check to the cover the bill, then agree to set one account among the other. Any remaining amount will be settled by one business issuing check. Transfers and setups. Contra entries will refer to the transfers or setups under one when a transfer is made from an account in the sales ledger to an account of the same business or person in the purchase ledger.
Chapter 17, Incomplete Records. In this chapter, we discuss incomplete records, advantages of double records, statement of business, formula, total profit, cash discount in incomplete records, markup, margin, and rate of return. Incomplete records. Sometimes business is small business in particular belong to this means that it runs financial statement cannot be prepared under a certain amount of regret calculations will be carried. Much depends on the records and whether a full set of financial statements can be prepared. Advantages of maintaining development records. Maintaining a full set of development record is important points. This includes the following: full details are available on the asset liabilities revenues. The preparation of financial statements will be relating this. The calculation of the profit or loss for the year is likely to be reliable. More informed decision making is possible. A greater degree of control over business activities can be exercised. The possibility of fraud is reduced. Comparisons with the results of previous year and business are possible. Detailed records are available for reference purposes. Information required by bank or other lenders is relatively available. Statement of affairs. If the only records available are those relating to the assets and liabilities of the business, it is not possible to prepare. These assets and liabilities are listed in a statement of affairs, which is similar to statement of application. In a list of assets and liabilities, there is a set of related to the cost of known as a statement of affairs rather than a statement of financial information. Formula: the assets, liabilities, and capital of business are known, and know that the only way the profit can be measured is to compare capital of the financial. Capital increases when a profit is made and reduces when a loss is made. The basic formula for capital profit is closing capital or opening capital. What are the differences between the two capital figures we call the drawing and the one? The drawing set is the formula and the additional capital. If additional capital has been introduced, this will also about the sum of the difference between the capital. The formula is closing capital and opening capital is drawing capital to the profit. Cash discount. Cash discount allowed to receive during the calculation of the exceeds and the expenses. The discounts must follow the recorded profit and loss section. Markup, margin, and leading to complete record sometimes increase percentages to calculate. Markup and these both measure the gross profit as a percentage. The markup is the gross profit measured as a percentage of the profit. The margin is the gross profit measured as a percentage of the price. Rate of return. It is sometimes necessary to use calculations in order to calculate the rate of return is the number of times the business increases the formula for calculating the rate of return is cost of sales upon average. Chapter 18, Part 1, Accounts of Clubs and Societies. In this chapter, we discuss NPO, non-profit organizations, receipts and payments account, nature of receipts and payments account, income statement, surplus or deficit, income and expenditure account, accumulated funds, subscriptions, not-for-profit organizations. This chapter concentrates on the accounts of non-trading organizations such as club and society. The main aim of these organizations is to provide facilities and services for their members. Making a profit is not the main objective. Examples of such organizations include youth clubs, sports clubs, amateur dramatic groups, golf clubs, scouts, etc. In some cases, a full set of double entry records is written up each year, but it is more easier to find that only a record of money received and paid is maintained. The main source of income of society is subscription. These are the amounts members pay, usually annually, to use the facilities provided by the club or society. A person is appointed to act as treasurer and be responsible for collecting any money due to the society and for paying money owed by the society. At the end of the financial year, the treasurer will usually present his financial statements to the members. These financial statements may consist of receipts and revenues account, possibly a trading account section of an income statement, an income and expenditure account, and a statement of financial position. Preparation of a receipts and payments account. A receipts and payments account is regarded as a summary of the cash flow from the financial year. Our money received is debited on our money various claims. The account is balanced as a balance carried out to become the opening balance for the financial year. The account does not usually distinguish between cash and bank transactions. So the balance may represent actual cash, money in the bank or combination of both. The debit balance is an asset and represents money owned by the society, whereas the credit balance is a liability and represents the bank overdraft. The receipt and payment account just make a cash book, records all money received and paid. It is important to remember that no adjustments are made for accruals and payments. No distinction is made between capital receipts and revenue receipts. No distinction is made between capital expenditure and revenue expenditure. Non-monetary items such as depreciation are not included. A real account. The receipts and payments account includes all money paid and received, including the year to which it relates, and includes both capital and revenue items. Preparation of income statement of a club or society. Although buying and selling is not the main purpose of club or society, many do carry out the trading activity. Many clubs operate a shop or a cafe where goods are sold and sold. At the end of the financial year, income statement trading section only should be prepared for use to the trading activity to show the profit under that activity. The trading section of an income statement of a club or society is prepared in exactly the same way as that for business. Any expenses which arise as a result of running the trading activity, such as wages of cafe assistants, depreciation of cafe equipment, and so on, should be added to the cost of the goods sold in order to calculate the correct profit and loss. Surplus of deficit. An income and expenditure account is prepared annually by a non-trading organization. It compares the gains and expenses to calculate the surplus. The surplus arises when the gains of the non-trading organization exceed the expenses. The deficit arises when the expenses of the non-trading organization exceed the gains. Preparation of an income and expenditure account. An income and expenditure account compares the gains of the club with the expenses of running the club. If the gains are more than the expenses, the difference is referred to as the excess of income or expenditure. This is known as the profit for the year in business. If the gains are less than the expenses, the difference is referred to as the excess of expenditure over the year. This is known as the loss for the year in business. An income and expenditure account is prepared using the same principle as those applied in the preparation of an income statement of business. It is important to remember that adjustments can be made for accruals and capital receipts and capital expenditure also are not included. Only revenue receipts and revenue expenditure are included. Non-monetary items such as depreciation are included. The assets and liabilities at the beginning and at the end of the financial year are not included. Where the club or society holds a fundraising activity, the income and expenses of this activity should be set off against the income and expenditure account. Accumulated fund. The accumulated fund consists of the surpluses less any deficits which have accumulated over the life of the organization. It replaces capital in the statement of financial position of the club or society. Preparation of a statement of financial position of the club or society. The principles applied in preparing a statement of financial position of the club or society are similar to those applied in the preparation of statement of financial position of the business. The statement of financial position of the club or society shows non-current assets, non-current liabilities, and current liabilities in exactly the same way as the statement of financial position of the trading organization. The main difference is that there is no capital in the statement of financial position of the club or society, whereas a business is usually financed by investment of capital from others. Members of a club or society do not invest money in the same way the proprietor of the business. Because of this, the members are not entitled to make any drawings in the club or society. This means that this surplus will be recommended to the organization to form a capital fund known as the accumulated fund. If the club makes a deficit, then the accumulated fund will decrease. This accumulated fund replaces capital in the statement of financial position of the club or society. Subscription. Subscription owing by the members are given balance on the subscription account and current asset is the current account asset is the statement of financial position. Subscription prepaid by members are paid balance on the subscription loan and the credit balance and the current liability is the statement of financial position. Subscriptions in receipts and payments account and income and expenditure account. The receipts and payments account shows the amount of subscription received in the financial year, but the income and expenditure account shows the amount of the subscription received in the financial year. This means that the amount received must be adjusted for any subscriptions owed by the members and any subscriptions paid in advance by the members. The calculation of the amount related to the financial position in the form of the account known as regarded as an account of the business in the organization. Subscriptions owing to members will appear as a revenue balance are a current asset to the club or society. Subscriptions paid in advance will appear as a current balance of the current liability because the club or society has an obligation to provide a period of membership which has already been paid for. It is possible to have balances, to have two balances on the subscription account. As the account is all for all the members, and some may have paid subscriptions in advance, and some may have not paid their subscription. At the end of the financial year, the account is closed by transfer to the income and expenditure account of the amount related to that financial year. Subscriptions economic. A club may have a policy that subscription is given and unpaid after a certain period of time or interval. The entries are made similar to those in a business rate of individual. The subscription account is credited with the amount written on before the subscription for the year transfer to the income. These irregular payments will be included in the expenses of the income. Calculation of sales and purchases. As the accounts of clubs or societies are often incomplete, it is often necessary to calculate credit purchases, and sometimes credit sales includes as sold and paid. Before the preparation of income statement, the same principles apply and calculating these figures for the business which have not got a separate complete set of accounting records as well are followed. Calculation of agreement fund. It is sometimes necessary to calculate the agreement fund of the club or society. This can be calculated by applying the same formula used to calculate the capital. In a business, assets is equal to liabilities plus capital. In a club or society, assets is equal to credit fund plus liabilities. Chapter 19, Part 1, Partnership Fundamentals. In this chapter, we will discuss partnership advantages and disadvantages of partnership agreement, contents of partnership agreement, interest on capital drawings and loan, partners capital account and current account, capital account versus current account. Partnership. The earlier chapters relate to business which is owned by 1,000 today. Another very common business is partnership. A partnership is a business in which two or more people work together. How many they cannot more than 20 partners. Professional people such as accountants and auditors often operate as partnerships. A large number of family businesses also run in partnerships. Sometimes a business is formed in partnerships. Sometimes a partnership is formed in social interest with family. Sometimes a partnership is formed in two or more businesses and ability of harmony. A partnership business will remain when and developed to records in the same way as at the end of the financial year, income statement is statement of financial condition. However, partnership will prepare an extra account after the income statement. This is known as profit and loss appropriation. Advantages and disadvantages. The advantages and disadvantages of partnership. Before agreeing to enter into partnership business, a person must consider the likely advantages and disadvantages. The advantages and disadvantages are compared as follows. Advantages. Additional finance is available, additional knowledge, experience, and skills are available, responsibilities are shared, risks are shared, discussions can take place before decisions are taken. Disadvantages. Profits have to be shared among the partners, decisions have to be taken among the partners. Decisions may take longer to put into effect. One partner's actions on behalf of the business are binding on all partners. Disagreements can occur. All partners are responsible for their business. Partnership agreement. The partnership agreement is a document setting out the rules and the partners will operate the business, including partnership. Contents of partnership agreement. Although it is not necessary to draw up a partnership agreement from the partner, it is advised to do so. Drawing up an agreement can avoid misunderstanding and misunderstanding. The clauses of the partnership agreement cover many aspects of the agreement. This related to the account legally important. Contents of partnership agreement. Amount of capital invested by each partner. Partners do not need to invest equal. How partners and losses are to be shared. Profits and losses will be shared equally in proportion to capital invested or less than the ratio. If interest on partners' capital is to be paid, and if so, what rate? This interest is a reward for the investment in the business rather than if all the partners are the same, it is not necessary to pay interest. Where partners invest different amounts, interest can be found from which to the person. Contents of partnership agreement. Partners' salaries are to be paid and if so, what amount? If all partners share the work and responsibility equally, not necessary to pay salaries. The salary can be found from compensation and partner share. If an upper limit is based on partner points and if so, what amount? The business will benefit if partners keep doing as well.
If interest on partners drawing system is charged and so on. This is method of discouraging partners from making drawings, especially early in financial year. Interest on bonds. Interest on withdrawal is capital. Withdrawal after the end of financial year. Interest on partners from this to be so about rates and extra financing for a partner and take a loan to and make a loan to to compensate for the loss of interest they could otherwise earn interest on loan. Loans from partners. The foundation may borrow money from one of the partners in extra financing, particularly in the finance. Loans for partners are not treated unlike investing additional capital, money lent to partners. Interest on the loan is business expense and not preparation of profit and loss of profit. Preparation of profit and loss of calculation for the partner. The profit and loss of calculation for the financial year after the income statement ensures how the profit for the relation in the partner. The profit for the is transferred to the partner. Interest on the channel and this must be added to the profit. The calculation of profit is detailed in the profit and interest in capital partnership. The remaining figure is not the residual profit and shares in the partner. Partners capital account. Similar to SO credit, member of the partnership and the own capital account. This usually revolves around capital accounts prepared in this way are referred to the capital account has a very partners current. Each member of partnership is also anything with the partner interest on capital interest partners have anything with the partners partners current. Great balance and current amount to the if the partners runs are more than these are on total share profit, the current amount will be higher as the partner owns to the partners runs are less than or high total share of the current account will have a great balance the partner. If current accounts are not in interest, the partners have this profit share. Where profit share drawings and interest according to capital. Drawings account. The drawings account is maintained for this time. Total of this account is capital versus current. Only for increases and increases in capital. Anything to which partner capital and current. Maintaining both the capital account and current account for which partner increases and whether the loans exceed the total information. Statement of financial position of preparation of financial preparation of the statement of financial position of partnership. Statement of financial position of partnership is so to the description of taxation. This measure will capital account and capital account it is not necessary to show all the things in the transaction. It is adequate to show the those balance financial account. Chapter 20, Part 1, Manufacturing Accounts. Manufacturing. This lesson we are going to discuss about manufacturing. Manufacturing business, manufacturing model, some of progress strategy, option transaction, allocation of business system. Manufacturing. Previous chapters business job, not different. Sell them without. There are almost the manufacturing business will maintain double-entry records similar to those of retail and wholesale. The end of the financial year income statement and possibly an accounting statement of the purpose of preparing this account is to calculate how much it is cost the business to manufacture. Manufacturing account is a part of the financial statements and used to calculate the elements of cost Viveka will go a furniture maker will park directly. The next station cost manager cost to which is then one can be better this cost is sometimes not directly not the staff these people have elements of cost directly. There are many expenses which a manufacturer can directly product with that the manufacturer may have to hire a complete the factory expenses, factory workers. These are expenses such as factory maintenance, factory machines, depreciation of factory machine, direct depreciation of all preparation of manufacturing, cost of manufacturing the basic product is calculated the cost of direct material is calculated so that it meets regular calculation cost of goods. The cost of that is actually closing it with the cost of direct labor indirect the total of these elements of three elements of cost the total cost of production is found that
Financial position, stable financial position of there is only one this, which manufacturer may have three different here and this chapter is considered not a exercise, not a here in this chapter 21 part 1 limited companies. In this chapter we discuss the company, private and public company, limited liability, related capital, share capital, types of shares, privileges, statement of changes in equity, financial statements. A limited company. Limited company is a legal entity which has separated entity from its shareholders. This liability for the whole company gets sometimes any business is formed. Sometimes a limited company is formed in a sole partner which is expanded. Share capital. The nature of a limited company. One person acting alone can form a limited company. There is no management of shares. A couple of companies divided into known as shares which can be of the shareholders of the company up to the since a company can have a large amount of capital can be the shares of the company have a face value far over $6 profits are distributed among this in the company which are often stated in terms of the shares. Public limited versus private limited. There are two types of private limited company. A company, the public limited company often its shares after it shares the public and private limited company is not allowed to offer its shares to the public. Limited liability. The viewpoint of the fact that the liability for the received company is limited to the it is also very sure that the limited company is separate so legal actions are taken against the company, not the administration. So apart from very small limited companies, it is not legally practical for members to take an active part in so a board of directors of the company. Your shares are held in the company to the institutions. The viewpoint of the company is that it is possible that loans can often be obtained more easily than the company has ability of participate in their partnership. And another consists of share capital. The company is formed as a if more of share is more capital is other shares. The company may not able to review on the shares. In this case, the total amount of company has reduced this may be less than the issue capital as may only call the amount that actually term credit capital, the product capital, conduct capital for its company directly received by share. Exertion. Shares are share capital of the company. Preference shares are the link by the preference of the receive the secret of which is given the dividend is the same ordered with the partner company and we left off the preference shareholders are not able to affect the types of seven types of how will be the same types and all the sheets are the professions are with any acronym that appearing in the professions are shown and a number of activities. Professions are not the organizations are also the leading business organization. The company owners the council levels this however, the organization is consuming if the company has a organization is an and for equity is the debenture is a long term investment profit. Debentures which are long term. Most loans just can be considered a low interest rate. The company is owned by the venture holders are not income statement. Income statement the only difference statement of service. The similar way, how the this is organization. It has already any organization forget sometimes the directors also this will appear in the script and the and possibly dividends among the these proposals are they are included in the script of very often they will not be positive, not this is not a section of the script. Leaving a balance of this is another sort of the general is also statement of statement of the asset section the non-current acquisition after that. So that it should the vendor is the assets belong to the hey, remember, I'm a trainer, not a tutor. I train you
to pass, to succeed, to clear your exams, to get better marks, to excel in your studies, so that you understand and do better and best, the best. It's okay. I've been taking on classes. I'm aware of difficulties faced by various students, below average, above average. I analyze and understand what they don't really understand and how the students suffer. I feel their pulse and try to understand their difficulties, making the student understand the subject and making interesting for them to learn so that they excel in their studies is my core perspective. These days, a lot of students have various difficulties. They won't understand anything in the class. A lot of students who are pursuing online classes, a lot of students who are taken up distance learning classes face various difficulties in understanding the core concepts. So they try to understand, but most of the teachers have different methodologies to explain, and few students are unable to understand. It's a hard time for the students. Myself, not being just learned, but having understood the subject as a common sense. I'm a professional tutor, professional trainer, and educator, having on-job experience and theoretical knowledge in various subjects, such as direct taxes, indirect taxes, accounting, be it financial accounting, advanced financial accounting, cost accounting, advanced cost accounting, managerial accounting, advanced managerial accounting, management accounting, advanced management accounting, financial management, operations research, quantitative techniques, business mathematics, business statistics, business economics, business studies, and various other business management subjects. I even have on-hand experience in ERP, SAP, Tally, QuickBooks, and all. So I'm in a better position to explain the real logistical issues, the logistical problems, the core concepts in a better way. So a lot of students approach me near the exams for exam-oriented crash courses and exam-oriented coaching so that they pass their exams. I have a record 100% of my students clear my exams, clear their exams with ease. 100% they succeed. So I explain them as if they are novice, ignorant novice. Even the ignorant novice understands the subject easily. So I teach them as a common sense. Because any subject is more a common sense than a subject. So a student should be capable of understanding the concepts so as to make their life easier. So learning becomes pleasure and enjoy. So anyone who is interested, who wants to clear their exams with ease, without any difficulties, please get in touch with me. I am available anytime for them. 24/7, I am available for them. Thank you. Caring is caring. So please subscribe, share to my channel, because spreading knowledge only increases your knowledge.
Dear students, welcome to Shasha's virtual classroom. So this is the first session for IGCSE. So the lesson is Introduction to Accounting. So this is a text from Catherine Pillow. And we have another text. This is from this one, Kanipur. Okay. So what is there in accounting in as per Catherine Pillow is the same thing. So understand and explain difference between bookkeeping, accounting, purpose of measuring the business profit and loss, explain the role of accounting to provide information for monitoring progress. So explain the meaning of assets, liabilities, and equity. Explain and apply the accounting equation. To understand the statement of financial position, record assets and liabilities in specific. So this is as per Catherine Gopal. So whether it is this book or Cranbrook's business accounting, it is the same thing. So here the lesson name of the lesson is accounting equation and the balance sheet. So ultimately the name of the lesson may be different, but what is the content? So what is the content is the same. So here there are several books written by several authors, and again some institutes come up with their own notes, their own syllabus and everything, but everyone will be within the ambit of syllabus that has been set by IGCSE. So after you have studied this chapter, you should be able to, what are the objectives? I explain what accounting is about, so what is accounting, describe the history of accounting, so explain the relationship between bookkeeping and accounting, so the same. Okay. Bookkeeping and accounting, this is the main uses of accounting information and what accounting information they are interested in. Present and explain the accounting equation. Bookkeeping, accounting. Explain the relationship between accounting equation and the layout of the balance sheet. Okay. So balance sheet is nothing but statement of financial position. So it is also called statement of financial position. Explain the meaning of the term assets, capital, liabilities, debtors, and creditors. So this is given in more detail. So describe how accounting transactions affect the items of the accounting equation. So then draw balance sheets after accounting transactions are occurred. So all these things we are going to learn in this in today's class. So it might be a lengthy class. So but we discuss the important things, and we will divide it into two parts. So we will divide it into two parts so that it becomes easier for you also to understand, grasp, and review, so revise, whatever. So we'll start with all these concepts. Okay. So introduction to accounting or the accounting equation and balance. So this is the name. So what is bookkeeping? So accounting equation and bookkeeping. So what is bookkeeping? See, a business needs to maintain details about the transactions being taken place. What are the transactions that take place in the business? Business may sell goods, may buy goods, may make the payments, may make payments for different amounts, like they may pay salaries, stationery. Similarly, they may receive even commission. So many aspects are involved. So what does the bookkeeper do? Bookkeeper is the first person. The bookkeeper is the first person who records the transaction from the source. Okay, so he records the transaction, detailed record. Detailed record of accounting information, detailed record of business transaction. Detailed record of business transaction is It's called bookkeeping. So the bookkeeper does everything. He records everything in detail. Like he may record the bill number, the amount, the account on which it has been received. So many things. The first source. Okay, the first source. Okay, first source is made by bookkeeping. So that is known as bookkeeping. Okay. So then what happens in accounting? So whatever information is derived from this is converted into financial statements. So what are financial statements? Financial statements are nothing but income statement, wherein you find out what is the income we have received, income statement, ultimate income statement. So position statement, so statement of financial position. It's also known as balance sheet, statement of financial position, and cash flow statement. So those are known as financial statements. So based on the data provided by bookkeeping, accounting is that. So what is the need? So any business cannot survive without profits, right? So after you do the business, you have to find out where are they standing, where is the status. So we have to evaluate your so that is why income statements are made. Income statements we can find out what is the profit, what are the expenses, what is the revenue, what are the expenses we gain, and what are the expenses we have done, and the net amount, what is the net result. So that is what is income. So what is statement of financial position? We make a list of what we have and what is owing to the business, what we owe. So many things are there. So that you will understand once we come to equation and related concepts. So as of now, statement of financial position is assets and liabilities. So we will come to know what is this. So what is the need? So we need to understand. We need to understand so that that is the main criteria for survival. So a lot of notes are available. So in the textbooks, you can refer the textbooks for a detailed discussion on this. So it's easy, so you can understand and you can write everything on that. So then we will proceed to the main concept, the main theme of this lesson, which is account equation and related concepts. Equation and related concepts and positions. Okay. So you have to remember 5 components. So basically, so what is accounting equation? Accounting equation says assets is equal to liabilities plus owner's equity. So owner's equity is also known as capital. So this is also known as capital. Is equal to assets is equal to liabilities plus. So now you need to understand what are the assets, what are liabilities, what is owner's equity. So all these things. This is the first thing you need to understand. Okay. So you may refer first lesson in AS level cash transactions. Therein I have explained the first step in accounting equation. So chapter 1. So you please refer chapter 1, part 1, and you can cross refer all the cash transactions, credit transactions up to lesson number 9, even up to 10. So the same thing you will study even in IGCSE, the same thing you study even in IAS level. So there the explanation is in a different way. So that if you want to understand, you can try to see, you can try to understand further, or you can understand further. But ultimately, the concept is okay, up to lesson number 10. 8, 9, 10. To lesson number 10. The concepts are almost the same. So you can refer there also. So they are almost done. I have completed the lesson number 10 in AS level. So which you learn in IGCSE also. But in AS level, it will be somewhat more complicated and it has been explained in some other way. So explanation, ultimate explanation and concepts are same. So if you don't want to confuse yourself, you can stick here. So I will be explaining the concept once again here also. So now see, suppose a person starts a business. Okay, so let us say a person starts a business. So once a person starts a business, what does he use? He will use his money, cash balance. He will have some money in bank. He may have his own building. He may have his own machinery. He may have his own furniture. He may have his own furniture. So he may have his own computer also. So let's assume he has a cash balance $10,000. Bank balance is another $5,000. Building is another $30,000. Machinery is another $10,000. Furniture is another $5,000. So computer is another $10,000. So let's assume this is just for assumption for you to understand. Okay. So he has started our person whoever he is. He has started a business with all these things. Okay. So the business will be using all these things to run the business. So business obviously needs all these resources. So these are resources. So 10,000, 5,000, 30,000, 10,000, 5,000. What is the total amount? Total amount 15. So 15, 44, 54, 67. So it's just illustrative the amounts. It may be much more, but just for you to understand. Okay. So the business owner, has invested all these resources in the business. So now, there is one more concept known as business entity. Okay. So what is business entity? What does the business entity concept say? Business entity concept says these are the assets of the business. Okay. These are the assets of the business. So what are the assets? Assets are some resources which are used by the business, which have been provided by the owner to the business to earn the revenue. So that is what is assets. See, it is very important. Very initially, you may find it somewhat difficult, but business, you have to understand accounting. This is very important. So this is very important for you to understand. So assets. Assets are what are assets? Assets are resources used by the business to continue running the business. So now what are the business entity concept? The business entity concept is that so much of assets are owned by business, but so much of money is owed to the owner. So this is known as owner's equity. So how much is owner's equity? Owner's equity is 70. So this is the owner's equity. So owner's equity is the business entity. The business has to pay back the owner dollars. The business has to pay that $70,000 to the owner. Why? Because the owner has given all these resources to the business. So understand, this is very clear cut concept. So this is the main concept. So if you understand this concept, we can move further. So this is very important. Very important, very easy concept. So you may take some time to understand this, but please understand. So the business has assets as well as liability. Assets is something it has, and liability is something it owes. To whom it owes? It owes to the owner. Why? Because the owner has given the resources to the business. The owner has given resources to the business. That is why the business owes back. Owes back. So, in that sense, should we consider that our owner is an outsider? Yes. Yes. Owner is considered as an outsider. So that is why the concept of capital owner's equity will come into. So whatever money the owner, the business owner puts into the business is referred as capital. The resources which are used by the business are assets. The money that is owed. So the liability, which is a commitment which business has to pay back to the owner for providing the assets to the business is known as owner's equity. So always assets are equal to liabilities. So suppose here this person, this business, he has taken loan, bank loan of $100 crore. So there is cash balance, bank balance of 100. So now the assets are 170,000. So liability is also 170. Why? Because the business has taken resources of, bank loan means what you will get? You will get bank balance. Bank balance will increase. So the loan is given to the bank, so the bank balance will increase. So the business has to pay that. It is a commitment, right? So you have to pay that. No. So how can you cannot enjoy the money and you cannot say enjoy. So you have to pay that. You have to pay that. Bank loan is a liability. So means owner's equity plus capital plus liabilities and equal to assets. Owner's equity plus liabilities is equal to assets. So what are liabilities? Even owner's equity is also liability. It is internal liability. Internal liability means it has to pay to an insider, the person, the owner. But liability, bank loan is an outsider. You have to pay. So even this also you have to pay. This also you have to pay. So always assets are equal to owner's equity plus liabilities, and this is the only accounting. This is the So now you have understood what are assets, what is owner's equity, what is liability. So what is liability? So the three concepts are clear. What are the concepts? Assets, owner's equity, so what is the equation? What is the accounting equation? What is the accounting equation? Accounting equation is assets is equal to liabilities plus capital minus. So in AS level, most of the times they use the word owner's equity. They never use the word capital. So some authors they present themselves to use the word capital. So don't get confused. Ultimately, the concept is important. So this is what it is. So the concept is crystal clear that assets is equal to liabilities plus capital or investment. So this is what we are doing. Accounting and so accounting equation understood. And this itself is also known as provision statement. So what are the assets available on the market? The assets available are these are the assets. These are the assets that are available, and these are the liabilities that the business has. So this when we put this in the form of a statement, it will mean statement of financial position or okay. So so we'll continue. Maybe in the next class we'll work out some questions. So we'll discuss this concept thoroughly. So what is the plan? The plan is that we'll discuss questions from Catherine book, and even that book. We'll discuss. So I will share you the questions so that they will be available on the screen. You can see on the screen. Then maybe you can pause the video and then you can answer yourself. Then after some time you can just check whether everything is correct. So ultimately after doing all the lessons, we will work out question papers as well. So we will be solving all the question papers. So possibly how much of the question papers are possible, MCQs, so different questions. All those question papers also will be solved so that you are crystally very strong in your to write your okay. So please subscribe, share. Please let others also know about this classroom, so virtual classroom. So help each other. So help me grow the channel also. Help me reach out to more students. So if you really like it, so if you have any doubts, please let me know in the comment section so that I explain to you more and more different ways so that you can just check out all the other lessons, and if you find any errors or if you have any mistakes or something, you can please let me know so that I rectify it and then I can improve it. So till then, good night, good day. I will do the final. So see you in the next class.
Dear students, welcome to Shasha's virtual classroom. So this is introductory accounting session. So hopefully you might have gone through the first lesson, introduction to accounting, the theory part. So now to start with, I just want to discuss certain points, certain important things with you. I believe that you are matured enough to understand whatever I discuss in today's session. See, accounting in IGCSE and A level. There is a accounting in IGCSE also and A level as both. Okay. So, what is there in IGCSE and what is there in A level? That is what I am going to discuss. So, how important is IGCSE for A levels? Okay. So, in IGCSE, will be discussing all these lessons. So, we'll be discussing, introduction to accounting, where you have accounting equation and all that stuff. So, but this will not appear again in A levels. A levels in the sense AS level.
So that the concepts whatever you are understanding here is applicable to the entire accountancy subject. Okay, entire accounting subject. So concepts are very very important. So understand the subject as well. So that is what is concept. Okay, the concept should be clear. What is the concept? Concept is why not. You should answer yourself. If your teacher says that you have to treat a particular item like this, you should be able to answer why you have to treat and why you should not treat it in that particular some other way. So that is what is concept. When you have reasoning skills, okay. So reasoning skills. So you should develop reasoning skills. So this is the specialty of IG, Cambridge International Board. What is the specialty of Cambridge International Board is reasoning skills should be very strong, your concept should be very clear, and you should have understood the subject. That is what it is. So, unlike other boards where you have to study lots and lots of things, but here you will be taught comparatively, you will be taught a lesser value, but the in-depth will be very strong. Okay, so it's very important. So that is why they will be the students of Cambridge International are very sharp. You have to understand the subject. You have to understand everything. Whatever you learn, you have to understand. Don't do like how kids used to do 1 plus 1, 2, 2 plus 3, 5, something like that. So without understanding what normally some students do, they will just remember things and then they do. They don't understand. They just remember things and then they do. No, never do that. So you have to understand everything. You have to understand everything and you have to learn the subject. If you start understanding the subject, then the subject will become interesting for you, and if you feel like studying it again and again, you feel like you are a master in the subject, you are understanding everything. So ultimately, your A levels, you will score very high grades in A levels. So if you are very strong, so from the day one, ensure that you understand all the concepts. So we will be learning introduction to accounting, double entry bookkeeping. In this, we will be learning how to prepare ledger accounts. What is a ledger account? So here we will study what is asset, what is liability, various accounting terms, very important accounting terms. All those things we learn here. Then the trial balance. So what is a trial balance? So what is cash book? Cash, how to record cash transactions, like when you receive cash or you pay cash. And then petty cash book. What do you mean by petty cash book? So various types of business documents like maybe receipt, payment, invoice, voucher. So many documents are there in business. So any business will definitely have document. Like suppose you go to a shop, they will give you a bill, right? They will give an invoice. Wherein they have written everything like what you have purchased and what is the amount payable. So that is what is the document. That is the document of one supermarket. Similarly, you transact, you go and buy anything from any shop, you will get a bill, you will get an invoice. So that is what is called document. So when you pay something, you give something, they give something. So that is what, because there is proper evidence of your payment, your receipt, or the transaction you have done with the particular business. Okay. So books of time entry. What are the books of time entry? Like you maintain sales journal, purchase journal. So cash book, so many things and all. So again, coming to the next part. Financial statement. So this is income statement. This is part B is position statement. So income statement means to find out what is the profit you have got in the business. Financial statement means position statement means what is the position of assets and liabilities. So what are the assets and liabilities that we will discuss in the first lesson. So accounting rules you have to follow in maintaining the books of accounts. You cannot write however you want because accounting rules should be followed universally. So you have to write the books of accounts. You have to understand the books of accounts in a proper way. Anyone who sees the books of accounts should be able to identify
is trying to tell. So other payables and receivables, so you may have to pay some money to some other person. So you may have to receive some money from the business people. So all those things. Accounting for depreciation and disposal of non-current assets. So what do you mean by non-current assets? What is depreciation? Irrecoverable debts and provision for doubtful debts. Bank reconciliation statement. So journal entries and correction of errors, control accounts, incomplete records, accounts at clubs and societies. This is called not-for-profit organizations, partnerships, manufacturing accounts, limited companies, analysis and interpretation. So this is all you will learn in IGCSE. So you believe it or not, almost most of this is again repeated in AS level. Okay. So most of it is again coming in AS level. So let us see what is coming in AS level. So this is a book from book by David Hopkins. So double entry bookkeeping, cash transactions, how you record cash receipts, cash payments. Double entry bookkeeping, credit transactions, how you record credit transactions, when you purchase on credit, when you sell on credit. Books of inventory, it was there in here also, right? Books of inventory, see. Books of inventory. Okay. So again, balancing accounts, how do you balance? All those things, this balancing accounts, you will learn in part A. Part A or part B, you will learn here itself. So balancing account, you will learn either here also you will learn. So then, classification accounts, division of the ledger. So in this, you will learn in this double entry bookkeeping part B. So the same thing, but the lesson names are different. The classification of account, the trial balance. The trial balance is also here also. See the trial balance. So what is there in the trial balance? Trial balance is here also. So okay. So then income statement for sole traders. So financial statements part A, part B. Position income statement of financial position part B. So here it is a statement of financial position part B. So then accounting rules. So what are these accounting rules? So these are the accounting rules. So the same thing. You have here also the accounting rules. So accounting principles or concepts in this itself. Accounting rules also along with this when you are learning the lessons here. So even along with this you will be learning accruals and prepayments. See accruals and prepayments. Accruals and prepayment. This is nothing but the same thing. Other payables and other receivables are nothing but accruals and prepayments. Then provision for depreciation of non-current assets. So provision for depreciation of non-current assets. Where is it? Accounting for depreciation and disposal. Irrecoverable debts and provision for doubtful debts. Irrecoverable and doubtful debts. Bank reconciliation statement. Bank reconciliation statement. See bank reconciliation statement. Control accounts. Journal entries and correction of errors. Journal entries and correction of errors that will come in suspense account here. So again, where is it? The trial balance also. So again, books of inventory also you get some entries. So then control accounts are here also, right? Control accounts are here also. See, control accounts are here also. So this is A levels, AS level and A level. Both. So one subject, one book for both. Okay. So till here, there is this is AS level. From here onwards, it's A levels. So now coming to again, so what happens? Then control accounts, incomplete records. See, where are incomplete records? See, incomplete records. Accounts at clubs and societies not for profit. Accounts for clubs and societies. So where is it? Not for profit organizations. So here, see in A level. Okay. See, one part is there in A level also. See, whatever you learn here. Accounts of clubs and society is not there. This is there in A level, so you have to be very strong. Okay. So then partnerships, see, partnerships. Where is it? Till here, sorry, till here. So it is A level, partnerships. Partnership changes onwards, you will have in A level. Okay. From here onwards, it's A level. Partnership changes. So till here, you have in AS level. So this is AS level. Okay. Now. Partnership, manufacturing accounts, see manufacturing accounts. So where are manufacturing accounts? See A level. Okay, see one lesson is there in A level. See how important limited companies, accounts of introduction to accounts of limited companies. Introduction to accounts of limited companies. A portion is there in A level also, a portion is there in AS level also. This is split into two, AS and A level as well. Okay, now then manufacturing limited companies, analysis and interpretation. Analysis and interpretation, see here, the last lesson is. Analysis and communication of accounting information. So basically, what I want to tell you is, so please focus on learning more and more points in IGCSE, so that your A levels become easier for you and the scoring becomes easy. So in the course of the classes, we will be doing questions from this book. So we will be solving question papers, previous year question papers, a lot of important questions, and even in AS level and A level also we will be solving a lot of concepts, important question papers, and a lot of other important stuff. Okay, so basically here I just want to help you. So we just want to help you in understanding the subject accounting, so that it becomes easier for you to score high. And so I just want to tell that IGCSE is equally important. So don't ignore anything. Take it seriously. Understand the concepts itself. So make use of. So what you can do is, you can even start answering some questions from AS level also. So related questions also you can try. So you can be way forward, so that you are prepared for A levels right from the initial stages, right from IGCSE level itself. You are ready for A levels. You should be ready for A levels. So you should be very proactive, so that you get very high marks, very distinctive marks. So that today's world is very competitive. So I have seen a lot of students dropping out from accounting subject because they feel accounting as a very tough subject. They are not capable of handling. Most of the students less very grades, and normally they will lose interest and all those things. So, but if you understand the concept, it's very simple. But try to understand the concept. Well, if you understand each and every lesson, it means you are able to understand the concept. That is what it is. Also, what do you mean the concept? What do you mean the concept means? Concept means if you are capable of understanding and solving the questions on your own, then you have understood the concept. So whenever I place a question in front of you, so what you can do is, you can just take a screenshot of that, try to answer on your own, and then you can just check the answer with the solution. So this is how your progress should be. So ultimately you will understand, and if you have any difficulty in understanding, you please let me know as a comment in the section. In the comment section, I will explain to you in several ways. Don't hesitate. Don't think you will look like an idiot. So please feel free to ask me any doubt, whatever, even if it is very silly doubt. Please feel free to ask us. So we are here to help you. We are here to guide you, understand the subject, and prosper in your academics. So next class we will start with
First lesson, Introduction to Accounting. So here we will learn lot of important concepts like what is the assets, what is the liabilities, what is accounting equation. So then what is bookkeeping, what is accounting. So lot of other concepts we will learn in the first lesson. Then second lesson we will learn how to record a ledger, what is a ledger. So all those things we will learn in second lesson. So here onwards, gradually we will be learning one by one lesson. So after finishing all the lessons, we will start working out even the question papers. We will start working out the question papers as well. So this one CAE question papers, okay, Cambridge International Examination question papers. So we'll catch up in the next class. Till then, have a good day, good night, bye bye.
Chapter 4, Part 1. Contents. Categorization of ledger accounts, sales ledger, purchase ledger, nominal ledger, cash book, the 2-column cash book, contra entries, blank order, the 3-column cash discount, discount allowed and receipt. Categorization of ledger account. Sales ledger. The ledger in which the accounts of credit customers are maintained. Purchase ledger. Ledger in which the accounts of credit suppliers are maintained. Nominal general ledger. The ledger where all the other accounts are maintained. Sales ledger. This is also referred to as the debtors ledger or credit receivables ledger. All the personal accounts of credit customers are kept in the sales ledger. Purchase ledger. Purchase ledger. This is also referred to as the creditors ledger or credit payables ledger. All the personal accounts of credit suppliers are kept in the purchases ledger. Nominal ledger. This is also referred to as the general ledger, and apart from the cash book, the bank account, and the accounts of credit customers and credit suppliers, all the remaining accounts are kept in the nominal ledger. This ledger will contain an account of assets, liabilities, expenses, income, sales, purchases, and dividends. Asset account are also known as real accounts. Accounts for expenses, income, and capital are known as nominal accounts. Cash book and petty cash book. Cash books. These contain the main cash book wherein all amounts received and paid in cash and checks are recorded. On the petty cash book contains details of small amounts spent daily on various accounts are recorded. The 2-column cash book. The 2-column cash book explains how two separate accounts, a cash account and a bank account, are maintained to record the movement of money. In practice, it is common for these accounts to be removed from ledger and shown in the separate book shown as the cash book. The cash account and the bank account appear side by side in the cash book. The rules of double entry bookkeeping are still applied. Any money received is debited in the cash book. If the money is placed in the cash till, it will be entered in the cash column, and if it is paid into the bank, it will be entered in the bank column. Any amount paid out is credited in the cash book. If the amount is paid in cash, it will be entered in the cash column, and if it is paid out of the bank, it will be entered in the bank column. The cash account and the bank account appear side by side. They still keep their own identity and must be balanced separately. Since the cash book is part of the entry system, it represents ledger account for both cash and bank. It is, however, also a book of prime entry because it is one of the most serious transactions to be recorded before being entered in the ledger. Contra entries. Contra entries sometimes surplus cash is paid in the bank or money when drawn from the bank placed in cash. Such transactions are known as contra entries because they appear on both sides of the bank. Debited to one account, credited to another. These transactions are recorded by applying the usual rules of double entry by debiting the account, receiving the money and crediting the account using the money. The name of the account where the double entry is made is entered in the details column. In each case, the letter C is usually entered in the folio column to indicate that the double entry is on the inclusive side of the same week. Bank overdraft. As explained earlier, the cash column and the bank column of the cash book are balanced separately as they represent two separate amounts. The balance on the cash column will always be brought down as the balance at the start of the next credit period. The only exception to this is when there is no cash left in the cash account. In which case the balance will be nil. It is not possible to have a credit balance on the cash account. It is, however, possible to have a credit balance on the account. The bank may allow the business to have a bank overdraft. This means that the bank allows the business to pay out more from the bank than it is then put into the bank. Interest will be charged at the bank on the amount withdrawn. In the cash book, the bank account is balanced in the usual way, and the balance will be drawn down on the credit side. This represents the amount the business owes the bank and is liability. The 3-column cash book. Many businesses maintain a 3-column cash book rather than a 2-column cash book. The difference is that the 3-column cash book has an extra money column on each side to record cash discount. The 3-column cash book. Many businesses maintain a 3-column cash book rather than a 2-column cash book. The difference is that cash discount is given. Cash discount is an allowance given to the customer when an account is settled within a limited time limit set by the supplier. An account does not have to be paid in cash to qualify for cash discount. The time of payment is the deciding factor rather than how the account is paid. Cash discount is a means of encouraging customers to pay their account promptly. The supplier will receive an amount slightly less than the due amount. However, the money is paid earlier, and so it is available for use within the business. Cash discount. The 3-column cash book has an extra money column on each side to record cash discount. Cash discount is allowance given to customer when an account is settled within a time limit set by supplier. An account does not have to be paid in cash to qualify for cash discount. The time of payment is the deciding factor rather than how the account is paid. Cash discount is a means of encouraging customers to pay their accounts promptly. The supplier will still receive an amount slightly less than the amount due amount. However, the money is paid earlier, and so it is available for use within the business. Cash discount allowed and received. Cash
discount allowed is the discount business allows its customers to pay their account within a certain time. This is an expense of the business at the most cost of handling that settled problem. Discount received is the discount of business users who receive a credit surplus. They place their account within a certain time. This is an income of the business which is the benefit received from certain account. It is important to realize that discount received does not involve the receipt of the surplus if you accept less money in security account. Dishonored check. A dishonored check is a check received with the debtor's bank refuses to pay. This may occur because the debtor does not have enough money in her bank account, or it may be because of an error on the check, example, no signature, not in if a check is dishonored, it is returned to the business that paid the check to the bank. The business must record the return of this check and debiting the debtor's account. The reverse of the address may be the check was received. The business will also inform the return to this amount is unknown.
Chapter 14, Part 1, Bank Reconciliation Statement. Chapter 14, Bank Reconciliation Statement. Learning objectives. In this chapter, you will learn to understand the use and purpose of bank statement and update the cash book for bank charges, bank interest, paid and received, correction of orders, paid, transfers, direct debits, dividends, and standing orders. Understand the purpose of and prepare a bank reconciliation statement to include bank errors and credited deposits and unpresented checks. We discussed a bank statement comparing bank with bank statement, the opposite side, classes of difference, timing difference, items not recorded in the bank, differences in two stages of bank reconciliation, prepare bank reconciliation statement. The bank statement. The bank will send a statement of regular returns to a customer detailing the transaction the bank covered with the statement mentioned in the bank record. It is similar to the statement of financial rates purchase is the bank statement is a copy of customer security. This is the record of transaction as they are paid to the bank. When money is paid to the bank, the customer's account will be paid. As this is the account to the bank of the customer. And when money is taken off the bank, the customer's account will be paid like this. The base is the account to the bank to the customer. The positive bank balance is paid as a great balance item and an overdrawn balance. Comparing cash with banks. The entries in the bank statement are compared with the results in the bank account. The bank statement is not they are recorded on opposite in the bank account is the record of bank. Money paid to the bank is recorded. The debit that the bank is returned to for this and money returned to the bank is for this. It is important to compare the bank statement and the bank account with the balance. If the two balances disagree, it is necessary to reconcile them to explain the difference. Opposite side. The entries in the bank column that they are given opposite side on which they are recorded on the bank statement. Causes of difference. Reasons why the banks stay a bank account and the bank statement. Difference between the two responsibilities are one part of the difference amount at which the same amounts are recorded. The business amount recorded certain items in time. Timing differences. These are usually due to checks not credited, not credited. These are checks that have been paid to the business and but which do not appear in the bank statement. This means because the payee has not paid the check into the account, because the check is still in the bank. Amount not yet paid. These are check and cash and check that have been paid in the bank which do not appear in the bank statement. It usually takes a period until the bank paid the correlations. Items not recorded. Often happens that the revenue does not record certain items until the bank statement is received. This includes bank charges and the bank may delay the amount from the customer's account to recover the cost of the and for any interest charge and the offer dishonored checks to the bank will be returned because the trial did not pass. Amount paid to the bank. These are great transfers, standing orders, and direct debits to the person in the bank.
amount of directly to the bank. Amounts paid directly to the bank to this includes state transfers, standing orders, and direct debits with the business as a paid to the bank. Differences in this beginning of the cost of whether that should be notified to the bank. The difference between the bank form data and bank statement items of cash with marking so it's not a credit to bank items in bank statement but not in bank bank checks and bank discounts sign orders to transfer bank debit zeros and bank statement. Stages of bank reconciliation. Compare the bank account data to the bank statement. The debit side of the bank account and the credit side of the bank statement. The debit side of the bank account and the credit side of the bank statement. Put it in the data stages of bank reconciliation. Upon the calculator items debited on bank statement, bank charges, transfer program, etc. should be paid to bank. Items paid on bank statement, transfer and stages of bank reconciliation. Correct analysis in the balance. The correct comparison in the balance. This balance is the correct bank balance. If it is the end of the financial year, this is the balance which should appear in the statement of financial year. Prepare a bank reconciliation statement. This should show why the balance of the updated statement does not agree with the balance shown on the bank statement. Start with the balance shown on the bank statement. Add any items which appear on the right side of the cash book but do not appear on the bank statement. Deduct any items which appear on the right side of the cash book but do not appear on the bank statement. Which is not a make any adjustment for the bank error adding to the and deducting amounts paid to the bank. The total of this calculation should be put to the another, it is possible to start the bank reconciliation statement with the in this case, it is necessary to do a set of bank reconciliation statement does not form part of the it is a statement which shows the bank account and banks bank reconciliation the bank overdraft. Exactly the same principles are followed in the bank overdraft. In this case, it is important because we take the calculation or wrong amounts. The bank overdraft will appear as a debit balance in the bank account compared to the business and as a debit balance of the bank. Advantages of bank reconciliation. The advantages of reconciling the balance in the bank statement on the bank account after updating the bank account and paying the balance in the errors in the bank account or bank statement can be identified. It assists in discovering order such not a present in these clean checks. These are usually those which are only 6 months old. They will not be the account of the
aniversare cât 20 de ani petrecuți împreună. Ne vedem la Roma Expo pe 23 și 24 august la petrecerea 20 de ani Kaufland. Să ne bucurăm de artiști iubiți, Smiley, Horea Brenciu, Teo Roz, Carla Streams, Direcția 5, de produsele cu care am crescut și mai ales de oamenii dragi. Intrarea se face pe baza cuponului gratuit din Kaufland Card. Activează-l! Kaufland!
Selamat berpuasa dan salam Ramadan. I have so much respect for everyone who is fasting this Ramadan because it's really not easy needing to wake up so early for sahur, then fasting the entire day with no food, no water, but still trying to stay productive and having a good daily routine. Mungkin ramai yang tak tahu saya sebenarnya membesar di Malaysia, sebuah negara Islam. Oleh itu, saya sudah terbiasa dengan budaya dan tradisi orang Melayu. Saya pun kadang-kadang berpuasa dengan kawan-kawan untuk berhungry dan berthirsty dengan mereka. So in this video, we'll go through the ultimate study guide for Ramadan, or how to study when you're feeling tired, how to structure your study sessions around fasting, how to stay productive even when you're exhausted, and how to avoid procrastination when all you want to do is nap, including what to do when your family is noisy and won't leave you alone, even though you need to get work done. Let's go. First, deciding when to study. When I asked you on Instagram, most of you said that you like to study either in the morning or at night. But the best approach is to actually do both. But there is a strategy to this. Whether you're a morning person or a night owl will determine the kind of work you should be focusing on during those times. A really easy way, bestie, to figure out when you work best is just by identifying your chronotype. There are actually 4 sleep chronotypes, so there's the bear, lion, wolf, and dolphin, and each one of them has a different peak energy period. Your chronotype will determine your best productivity times when your mood is naturally elevated and the best times for eating, sleeping, and studying. I'll leave the link to the quiz that I took personally in the description box below. So that's the first thing that I want you to do, bestie, after you finish watching this video, because once you've identified your chronotype, it's time to structure your perfect study session for maximum efficiency. So, how to choose the right tasks for your study sessions based on your energy levels. Your peak productivity periods, which will be different depending on your chronotype, should be spent on high focus tasks, while your low energy periods should be spent on less demanding work. Examples of high difficulty tasks are doing past year papers, anything to do with complex problem solving, essay writing, exam revision, deep learning, and memorization. So that means if your peak productivity periods are in the morning, you should be doing these tasks after subuh. But if you're a night person, you would be doing these tasks after isha. So this includes subjects like mathematics or sciences, or any subject that requires deep concentration and a lot of brain juice. And if you have a weak subject that you really want to improve on, this is the best time to work on that. I used to struggle a lot with mathematics. I don't know, me and numbers just don't get along. So what I would do is I would wake up at 4 a.m. every single morning before school starts to do 2 past year papers. And I actually went from scoring C's to distinction in A-levels. Now, what kind of tasks do you do during your low energy periods? So for my night owls, that's after subuh, and for my early birds, this is after isha. This is the time for you to write notes, review them, do homework, flashcard revision, and light reading. Tasks that don't require as much brain power to do. I really like using my low energy periods to recap information that I memorized in my high energy periods. But if you want my honest advice, bestie, you should be using this time during Ramadan to adjust your body clock and become more of a morning person. Why? Because classes and exams are held in the morning, so training yourself to be more alert during those times will really help you perform better and improve your grades. So if you ever wanted to fix your sleep schedule, then this is the perfect time to do it. And if you want more tips on how to become a morning person, you can check out my video here. But like this video and subscribe if you're enjoying it so far. But if you're feeling exhausted, especially during Ramadan, which is completely understandable, the best way to be productive with minimal effort is by turning your phone from a distraction into a tool. I've spoken about this before, but you don't even need to get out of bed. You just switch to a more productive app. You can learn languages or play chess, but personally, I have no interest in those, so I use this app called Brilliant instead. I've been recommending this app for the past 3 years, but basically, it just turns any complicated STEM subject like engineering, programming, AI, computer science, and they turn it into game-like, fun, bite-sized lessons. It seriously looks like a game, but you're actually learning something. I am pretty sure that Brilliant just updated their math courses, so now the additional content will focus more on problem solving and logical reasoning, so if that's what you're interested in. My favorite are, of course, the science courses, and so you learn how to think like an engineer and develop your scientific intuition, but honestly, it's just a really good way to determine if that's what you want to pursue in university. You can actually try Brilliant for free for 30 days by scanning this QR code that I'll put on the screen, or you can visit brilliant.org/fayfilms. I'll leave this link in the description box below because you can also get 20% off the annual premium subscription by using the same link. Next, how to maximize your productivity. When we're tired, we won't be able to finish everything on our to-do list, and that's okay. And so what should you prioritize when your energy is low? We're going to use something called the eat the frog technique. I don't know why they chose frog, but let's just go with it. Basically, bestie, you'll start your study session by tackling the hardest, most challenging task first. For example, if you have a project deadline, an upcoming exam, or a long essay to write, that will be your frog. Again, why frog? People will tell you to do this because it builds momentum and it gets the hardest thing out of the way, but I'm going to tell you that the more important thing is that doing this gives you flexibility. If you're a morning person and you don't finish your task, you still have the rest of the day to complete it. If you're a night person, you can get the bulk of the work done before midnight and you can finish it up in the morning when you have less energy. And I say this out of experience because in Malaysia, Ramadan almost always coincides with exam season, which is really unfortunate. So me and my friends, remember how I used to fast with them to just give them support? We found out that getting the hardest work done first make a huge difference. When you're tired, you can fall into the trap or the habit of pushing things like revision or memorization back day after day after day because you're too tired to do them. Let me know if you also struggle with this in the comments, bestie. So instead of working on them when you feel like it, just tell yourself to start with those difficult tasks first, and then you can move on to the rest. An advertisement might play in the next few seconds, so if you would like to support this channel, please do not skip the ad. Thank you. But how do you shorten your study sessions? Here's the trick to actually getting work done efficiently to shorten your study sessions. Whatever the amount of time you think you need to complete a task, cut it in half. So if you think you need 2 hours to finish your notes, give yourself 1 hour instead. Instead of dragging out an 8-hour study session, you get the same amount of work done in just 4 hours. And what do you do with that extra time? You can either use it to rest and recharge or shift it to morning or night to refine the work that you just did. Remember what I said in my How to Be a Perfect Student video? You might tell me, if I spend half the amount of time making notes, it's gonna look like a chicken made it. Or if I spend half the amount of time revising, I probably get all the questions on a past year paper wrong. And that is completely true. However, if you don't get stuff done, you don't know how to improve. If you want a deep dive into a lot of non-basic study tips that will transform you into a top student, then you can check out my video here. Next, what if my family is noisy? Can you tell that I'm Southeast Asian? Because Southeast Asians know the struggle when it comes to having a noisy family. During Ramadan, I know a lot of you will struggle with getting work done because your family is all awake and your siblings, are bothering you in one ear and your parents are nagging you in the other ear. So here are a few small changes that can make a world of a difference that you can try. You can try putting on headphones and listening to white noise or brown noise. YouTube has many options and I find that this is less distracting than actual music. Or you can listen to lo-fi. So I already have 2 study with me sessions posted online. I will film more, I hear you. I'll leave them in the description box below. You can put that on and feel like you're studying with me in the library instead of a distracting environment. But if your family is noisy no matter what what my friend did was that she tried to get as much work done in school or outside before she got home. So during lunchtime, because she can't eat, she'll sit with us and do her work instead, or in between classes when waiting for teacher, and sometimes she'll even stay in the library before going home. If all else fails, bestie, just embrace it. Embrace the chaos and be able to work in a noisy environment. You will build an insane ability to focus anywhere, which is a superpower, by the way. This will really help you during exams, in workplaces, or just life in general. If you've made it this far into the video, comment down below what you're grateful for this Ramadan to get triple the blessings in return. Thank you to my dear friend Sophia Amira, my old tuition teacher Cikgu Sabaria, and all my Muslim besties who wholeheartedly gave me their advice and contributed to this video. Remember to like this video, subscribe, and turn on the notification bell and set it to all so that you don't miss out on any future uploads. Thank you for 1,370,000 subscribers, and I'll see you all in my next video. Bye, bestie.
Dear students, welcome back to Shasha's virtual classroom. This is a small rectification video. Okay, so rectification video in the sense, it is a very small rectification, minor rectification. So in the previous class, that is chapter 1, A4A, we had done this problem. So in this, 12,500 minus 1,800 is 10,700. So 10,700. So whereas in the answer in the previous class, it was mentioned as 11,700. Also, it was a small mistake, but it was not brought to my notice. So I felt very sorry for my dear students because they didn't let me know about the mistake. I would have rectified it long back. So now, just after going through my own videos and own classes, once again I just found out this small mistake. So please, students, please let me know if there is any error because even I am a human being. So it's a very small mistake. So instead of I had taken instead of 10,700, I have taken 11,700. So please let me know. Okay. So that's all. So we will continue with chapter 1B4B going further. So dear friends, today's class we will discuss some questions based on lesson number 1, the first chapter. So based on those concepts, accounting equation lesson concepts. So here we will discuss. So be sure that just have a. So this is Frankfurt's book. If you haven't already answering them, if you haven't already started answering them, you now have a set of graded reading questions to try. Graded means that they get more difficult as you go through them. I believe they should be done in the sequence as they appear. However, don't forget the questions with an A after the question number do not have any answers provided in this book. Your teacher or lecturer will be able to provide you with the answers to these questions, but be sure to attempt them first before asking for the answers. The answers for other questions can be found at the back of the book. We realize that you would like to have all the answers in the book. However, teachers and lecturers will not then be able to test your knowledge with questions from this book. As you would already possess the answers, it is impossible to please everyone, and the compromise reached is that of putting a large number of review questions in the book. Okay, so this is very important. So a wise decision by Frankfurt. So I 100% agree to this. So this is what is my approach. So whenever you see any questions, you have to first try answering them.
So if you are unable to answer them, then you have to just go through the lesson once again, try to understand, then again try to answer it. Okay, so these are the questions from triangle. So so we just start discussing. This means that appropriate reinforcement of what you have done can take place even if you are studying on your own and have to miss out the real questions because you have no access to the answers. Multiple choice questions. But in this lesson, in this class, in virtual classroom, we'll discuss all the questions. Okay. So whether they are real questions or whatever. So before that, we just try to answer yourself. So multiple choice questions. So now here you can see what is the complete the gaps in the problem table. Assets, liabilities, capital. So what is the equation? Assets is equal to liabilities plus capital. So that is the equation, right? Assets is equal to liabilities plus capital. So if this is 12,500 and this is 1,800, what this will be? This minus this, that's also 12,500 minus 800. 11,700. So the first answer is 11,700. So 28,000 minus 4,900 is again 28 minus 5 is 23. 23,100. So 16,800 minus 12,500. So this one will be 25,500. You have to add this and this, so that will give you this number. So okay, here also 19,600 minus 16,400. 19,600 minus 16,450. 3,150. So this is, so this will be this plus this. 11,650 plus 39,750. 51,400. Okay, so that's also simple it is. So I think this one you can try. So we'll discuss these questions in the next class. Okay, so we'll discuss in the next class. The very next class we will discuss this. So now you can try answering this on your own. So maybe you take a screenshot of this and you can start working out and you can keep it ready and you can see IGCSE C1 P 5. Okay, 5 or 6. Okay, C1 P5 or 6. So they are related. So I am giving one number for each and every lesson. So in a sequence so that you can easily follow them and you can understand in a better sense. So you have to go it in a logical order. So see, that is what even the author has recommended. So see what the author has recommended. If you haven't already, see here you can see. They should be done in the sequence they are here. Okay. They should be done in the sequence that this is very important. So we will also go lesson wise, we'll go everything topic wise, concept wise, we'll go one by one so that the concept understanding is clear. Which are the following items in the following list are liabilities and which are them are assets? Loan to C surely. Loan to C surely means you have given loan. You have given, so it is an asset, right? Because you have to receive back. So you have given to someone. So it is an asset. You have to receive that money back. It is not loan from. It is loan. It is an asset. So B, bank overdraft. Bank overdraft means you have taken temporary income from bank. You have to pay liability. So fixtures and fittings, asset, something you have. So to use in business, asset. Computers also asset, you have something to use in business. We owe a supplier for goods. So we owe, no, it's liability. Simply it's liability. Whereas we own, we are owning it. So asset. Okay. So this one again you can do it as woman. This is a woman. This is a woman. So answers for this we will discuss in the next lesson or class. Next lesson or next class. Okay. Next class. It is the same lesson. So it is not next lesson. It is next class. We'll discuss this. So that is C1 P5 IGCSE. C1. It should come here. So cash in hand, it's correct. Machinery is correct. Creditor is wrong. So it is wrong because it is not an asset, it is liability. Premises is an asset. Motor vehicle is an asset. So again, stock of goods. Stock of goods is an asset. Is there something you have? Debtors. Debtors is also something you own. You own. Okay, something someone owes you. What is asset? Asset is something you own and something that is owed to you. So debtors are paid customers and they owe you money. Money owing to bank. So this is correct. Okay. So this is how you just check the concept of whether you understood the concept of assets and liabilities. It's very important, very basic, but very important. So again, this one is homework. C1. Okay, so we'll see what is required here. So why is he setting up a new business? Okay, before actually selling anything, you bought a land for 4,500, a market start for 2,000, and the stock of goods for 1,500. So van, market stall, stock, so put together, so 45. 2,000, 1,000. Okay. He did not pay in full for his stock of goods and still owes 1,000. 1,000. He borrowed 5,000 from C Fox. These are the liabilities which he has to pay. So these are the assets which he has owned. Okay. Amount pay. He borrowed after the events just discussed and before starting goods. He has before trading starts, he has 400 cash in hand and 1100 cash in bank. So these are all assets. Just see. So 4500 is 1, 2000 is market stock of 1 is 1500. So he did not pay 1000 which is liability. He borrowed 5000 liability. So after the event just discussed before starting, he has 400 cash. 400 cash in hand and 1100 in cash in bank. So these are all assets. So just add them. 4500 plus 2000 plus 300 plus 300 9400. So this is 6000. So what is capital? Capital is 3000. Simple. Because assets is equal to liabilities plus capital. So capital is 3500. Capital is 3000. Okay. So this one you can write as homework. Inform detail. See how good the problems are. You can just understand and you can the concepts will be very clear. Draw G put his balance sheet from the following information as of 31st December 20 dash. Okay. So capital 72. So you have to draw balance sheet. Balance sheet means where the assets will be, where the liabilities will be. So liabilities, assets. So liabilities, this is. So what are the liabilities? So this is liabilities capital, right? So this is capital. Capital is 7200. Debtors asset, van asset, creditors 1600 liability. Creditors are suppliers to whom we have to pay credit. Fixtures asset 1800. Stock of goods 4200. Cash at bank 300. So these are the assets. This is liability, this is capital. So just see 200 plus 3800 plus 1800 plus the task is 1 2 1200. Sorry, it's not 70 bits. 1 2 1 2 1 2. This is 5. Correct. 11,300. So 7,200 plus 1,600. 7,200 plus 1,600. 8,800 minus 7,300. So 2,500. So capital is 2,500. Another amount. Creditors 1600 is correct. Van 800 is correct. Fixtures 1800 is correct. Stock of goods 4200 is also correct. Cash at bank 300 is also correct. Capital 7200 is incorrect. Creditors 1600 is correct. So this is additional capital. So this one you can do it at home. Complete the column columns to show the effect of the following transactions. Okay, so this is accounting equation. So we'll continue. So till here we'll make it as part A. So this one will be part B. So we'll start this in the next class. So till then, bye bye. Have a good day. So dear students, welcome back to Shasha's virtual classroom. So let us start with the next lesson, that is chapter 1B, 4B. Okay, so we had done in the previous class, we had done till here. So we will be starting with this. So complete the columns to show the effect of the following transactions. So basically this is related to accounting equation question. So complete the column to show the effect of the following transactions. So we pay credit on 70 in cash. So we pay credit on 70 in cash. So what happens when we pay credit on 70 in cash? Obviously, who is creditor? Creditor is a liability, no? So creditor is a liability. So liability will come down by 70. So all the amounts are in pounds. So pound 70. So what is the other effect? Even the assets, even the cash will come out, because cash will fall because we are paying. So cash is going out to pay sundry creditors. So both cash is going out and liability is paid off. So both will come down. So it will not have any effect on capital because there is no profit element or loss element. So it will not affect the capital. Okay. Bought fixtures pound 200 paying by check. Bought fixtures pound 200 paying by check. So what's happening here? So see, asset will come in. So what is the asset? Fixture will come in. Fixture will come in, that is 200 will come in. This is fixture. And money will go out. So money will go out from bank. So it is also 200. So bank 200 will go out from bank. So what is the net effect? Net effect is nil at all. So there is no effect on assets because one asset is increasing, the other asset is decreasing. So there is no effect on assets. No effect on liabilities as well. No effect on capital. Bought goods on credit 275. Okay, bought goods on credit. So what will happen? So stock will increase. So inventories, goods. Okay, inventories, goods or stock, whatever you call it as. So they will increase. This plus. Okay. So liabilities also will decrease because we have to pay. You have to pay them later on. So credit means you have to pay them later on. Even this will increase. This also will increase. So you can say this is coming down. This is going up. Assets are also going up. Liabilities are also going up. So this is coming down. Liabilities are also coming down. So for the second one there is no. Okay. So then the proprietor introduces another 500 cash into the firm. So what is happening here? Cash is increasing. So 500 pounds are increasing because the cash is coming into the business, right? 500 pounds are coming in. So similarly, capital is also increasing. So 500. So capital is also increasing. It is also increasing. J. Walker lends the firm 200 in cash. So what is happening here? Walker is a person who is a lender who is giving So it's a liability. So again, cash is increasing. So cash is increasing by 200. Cash is increasing by 200. And even loan liability. Okay, liability is about we have to pay back. No, if we get money from Jay Walker, we have to pay him back, right? So we have to pay him back 200 rupees. So interest is another issue that is a different aspect. So we have to record it separately. But as of now, cash will also increase and liabilities also will increase. At the top is US dollar 50 by check. Okay, so what is happening? At the top is by check. At the top, who is at the top? The top is a customer to whom we have sold goods on credit. So he has paid us money. So what will happen? The top cash will come in. No? So bank account will increase. So bank account will increase by 50 bucks. Bank account will increase by 50 bucks. Bank. So, and what will happen? The top pay. So he had to pay us. So his account will come down. That even that is debtor. So both are assets. So one asset is increasing, other asset is decreasing. So the net effect is nil. So the net effect is nil. Okay, so then we return goods costing $60 to supplier whose bill we had not paid. We return goods costing 60. We return goods. So what is happening? Goods are going out back to supplier. So goods are going out. Goods are going out. Stock, inventory is going out. And whom we are giving it back? To a supplier. Supplier, who is supplier? Supplier is a liability from whom we have purchased goods on credit. So even that will come down, right? So even that will come down. So capital account it will not hit. So capital account it will not hit. Okay. So then bought additional shop premises paying 5,000 by check. So what is happening here? Money is in premises is increasing, whereas bank account is decreasing. So there is one increase of an asset, there is decrease of another liability. I mean the same asset. So asset is increasing, one asset is increasing. Which asset is increasing? Premises is increasing, whereas check, and that is bank. Okay. So bank is decreasing. So the effect is net effect is because it is hitting both the accounts are hitting asset account itself. So there is no effect on liabilities, no effect on capital. So this is what is this one. So what you can do is you can just try this question, complete the columns to show the effect of following transactions. And this is a homework. Okay, so this is a homework for you. Please try doing this so that if you have any notes, please let me know so that so maybe we will work out the solutions in class. What do you say? C1, P5, or C1, P6 if you want. Okay, so unless otherwise you let me know, I'm not going to do this. It is assumed that you can do this on it. So, sorry, but I need you also to try this problem on your own. So, otherwise, there is no point in me doing everything and just you are watching like a movie. So, that's not going to happen. So, you have to put your efforts and you have to let me know that even if one comment on in the section of this video will make me happy. So, I will be happy to post the answers for this. Okay. So next question. Okay. So 1.13. So that is G. Brown has the following items in her balance sheet as on 30th April 20 dash capital 18,400, creditors 2,100, fixtures 2,800, car 3,900, stock of goods 4,550,
So debtors 2,780, cash at bank 6,250, cash in hand 220. So during the first week of May 20-8, she bought extra good stock for goods 408 on the debtors paid to 920 by check. She bought a computer by check only 50. You are asked to draw a balance sheet on 7th May 20-8 after the above transactions have been completed. So you are supposed to draw a balance sheet. You are supposed to draw a balance sheet. Okay, so let us see how to prepare a balance sheet.
Okay, so this is what the information that has been given in the question. So these are the assets and these are the liabilities. So they are asking you to prepare the balance sheet. Okay, she bought extra stock for goods 400 on credit. So she bought extra stock. So stock means this one 450. How much? Worth 400. On credit means plus 400. So this will increase and this will increase. Both creditors and stock will increase. Next one. One of the debtors paid 920 by check. One of the debtors paid 920 by check. So one of the debtors paid 920 by check. So this will come down, but this will increase. 920. So then the next one. So what is it? She bought a computer by check 850. She bought a computer. Okay, so computer is not there. Computer. $850 by check. So 850. So minus 850. Minus. So this is the new balance. So the net effect. So this will become 2500. So this will become 2500. So we can just so this will become 4950. So 2780 minus 920 is how much? 60. 7 minus 9, 8. 7 minus 9 is 6. So that I don't commit a mistake again. So take some time, don't commit silly mistakes. 2780 minus 920, 1860. 1860. 1860. So this will become bank balance will be 6050 plus 920 minus 6050 plus 920 minus 850. So 6320, this will become 6320. So all other figures will be the same. So this is the answer for this question. So whatever question has been asked, this is the answer. This is how you have put in the problem. Always liabilities will come on the left side and assets will come on the right side, or you can write one below the other. So whatever it is suggested by your school teacher, you can do it. So it can be presented in different ways. The ultimate amount is the net amount, the net return. Okay. So this is over. So then this problem is done. So you can try the next problem. This problem is as a homework. So you can try this problem on the homework. Then you can get that. So okay. So it's the end of the lesson. So we have done almost all questions from this lesson. So this one you can try on your own. And please let me know if you have any doubts. Please let me know as a comment. We can I can look for the solutions in C1, P5 or C1, P6 in the next class. So in case you have any doubts or if you found any mistakes can do is let me know. Even we are humans and silly mistakes are going to happen, but intentionally nothing will be done wrong. So you can be rest assured. So all the best. So we will catch up in the next class. Dear students, welcome to Shasha's virtual classroom. So this is a book by Catherine Bucom. So chapter lesson number C1. So C1, P4, A and D we have discussed Frankfurt's book. So the same concepts are discussed even in this. This is Catherine Bucom, it's from Catherine Bucom. Okay, so define the term bookkeeping. So define the term bookkeeping. So definition you need to learn. Definitions you have to write as it is written. So you can see bookkeeping is a process of detailed recording of all financial transactions of the business. So this is what is bookkeeping. The next question is what is accounting? Accounting is a bookkeeping record. Uses the bookkeeping records to prepare the financial statements. So the next question is why should you prepare financial statements? So the progress can be measured by comparing the financial statements or done here with previous years or the calculations. Ratios, the information for ratios, so many things. So it's a simple question and a simple answer you might have. So it's very small thing. So state what is included in the term financial statement. So financial statements include income statement and position statement, or we call it as a profit and loss account and a balance sheet. Okay. So then assets, liabilities, and capital. So see the question here. So what are assets? Assets are something which the business owns and which is owed to business. So that is what is assets. So what are liabilities? Liabilities is something which is owed by business, so which the business has to pay back. So suppose you have taken loan, so that is what is liability. So you have taken back loan, you have to pay back. So that is what is liability. So you have purchased goods on credit, you have to pay back money. So that is what is liability. So what are assets? Assets is something you have like land, you need for purpose of doing the business. Maybe you have machinery to manufacture. So that is what is assets. So you're using it, keeping it in the business to use it for some period. So that is what it's called asset. Asset is something. It is a resource controlled by an enterprise from which future benefits are expected to flow. So it is something which is owed to you and which you own. Okay. So what is capital? Capital is nothing but the investment made by the owner into the business. So that is what is called capital. This we have already discussed in lesson number 1 in detail. So very small thing, you fill in the missing figures in the following table. Okay, so what is this? The difference between this and this. So you know the accounting equation, right? What is the accounting equation? The accounting equation is assets is equal to liabilities plus capital. Right? So what is the accounting equation? Assets liabilities plus capital. So this is the accounting equation. You have to remember this. So it means what this minus this will be this, right? So 35,000 minus 12 22,000 pounds. Capital will be 22,000. Very simple. It's very simple. So, capital, what are assets in this case? They are given both the sides. So 300 by 700. So 19,000 plus 4. 63,000. So 63,000.
So in this case, what it is? So assets minus capital is liability. So 67,300 minus 12,300. So very simple. So very easy. It's very easy. I think you have understood. So you might have done. So even that, just for your confidence and so it's very easy concept. Okay. So then give two examples of each of the following excluding those shown in asset. So other than this means cash. Okay, so cash is not generated, so asset means cash. Give two examples. So cash can be one example. What can be the other example? Furniture is not, right? It's furniture. So here, what are the other example of liability? Bank loan. So what can be the other example of other liability? So loan from friend. Okay. From whomever you are taking, you have to pay it back. So it's a liability. Explain the meaning of each of the following terms. Trade payable. So what is trade payable? Trade payable is nothing but when you purchase goods on credit, at the time you have to pay back. So that is what is trade payable. So what is trade receivable? When you sell on credit, at the time you have to receive back the money from the customer. So this is the money payable to supplier. This is the money receivable from customer. So let us check. There are some exam style questions. Maybe like these are MCQs which keep appearing in the MCQs. Which task is performed by a bookkeeper? So analyzing the trading ledgers, no. Entering transactions in the ledger, yes. Preparing year-end financial statements, no. Providing information for decision, no. So which task is performed? So entering transactions in the ledger. This is the only thing which is available. They will not do any of the other things. They will not do any. The trader provided the following information: premises 180,000, inventory 23,420, trade payables 26,180, trade receivables 21,710, other fixtures 22,600, loan from loans 80,000, cash and loan 2,550, motor vehicles 15,900. Calculate the value of the assets. So what are the assets? So this is an asset. This is an asset. So this is an asset. This is an asset. So this is also asset, this is also asset. So these are all assets, okay? So simply add this. So what you get is the sum of the assets, okay? So this is asset, this is asset, this is asset, this is asset. So then calculate the value of the liabilities. Value of the liabilities. So what are the liabilities? This one, loan from bank, or the liabilities, okay? So these are the liabilities. So this is the liability. And this is the liability. Trade payables is the liability. Loan from bank is the liability. Use the accounting equation to calculate trader's capital. So add all the assets. You see what are the assets? Let us check what are the assets. 180,000 less 23,420 less 21,710 less 32,600 plus 2,550 plus 15,900. 276, 180. 276,
180. Assets are 276. 180. So what are liabilities? So okay, so on dollar, so going to dollars and dollars. Liabilities is how much? 26,180 plus 80,000. So 106,000. So 106,180. So what will be the capital? This minus. So that is what is capital. So 276,180. So it will be 70. Yes, 70. 70. This 7 plus 7. So 2 minus 1 is 1. So 170. Okay, 170 is the capital. Which is a statement of financial position? The calculation of amount due to owners of the business, a list of assets and liabilities of the business on a certain date. Yes, a list of everything owned and owed by business, a summary of money paid to and received by business. Now, a list of assets and liabilities of the business on a certain date. So this is what is financial position. So then, a business had $94.20 on its bank account. The following transactions took place. Bought goods on credit. This will not hit the bank account. This will not hit the bank account. So sold goods on credit. This also will not hit the bank account. Repaid a loan budget. So money will go. So 9,540 minus 5,000 will be 4,000. So 9,420 minus 5,000 is 4,420. This one. So answer is this one. Okay. So that's all. Complete the following to able to show the effect of the following transactions. The first has been completed. As an example, bought a motor vehicle and paid by check. So what are the two items that are in motor vehicle and bank? So motor vehicle increases and bank decreases. Just because when you buy a motor vehicle will come in and you have to pay money, right? So when you pay money will go out. So effect on liabilities, no effect on liabilities. There is no effect on liabilities at all. So this is how you have to do. It's very simple thing. So I think you can try on your own. So I will give you just a minute so you can take a screenshot. You take a screenshot of this question. Try it and just discuss it. Okay. So just try on your own. It's a very simple thing. So if you don't understand, then you can do. See, this is how you have to learn. Otherwise, if you don't watch the problem as a movie, like just you keep seeing the movie, you will not understand anything. Afterwards, when you start doing it, you will get lot of doubts. No, you should never do that. So always what you have to do is you have to start doing the problem. Actually, you have to start and sit and write down, put it on pen and paper. Please put it on pen and paper. So please write down wherever, but you have to write down, you have to do the problem. Actually do it. So okay, actually do it and then check the result whether you've done everything right. Okay. So bought goods on credit from a credit supplier. So what are the two items that are affected? One is inventory. What is happening to inventory? Inventory is coming in. Inventory or goods. Okay. So it is called inventory, or they are also called as goods or merchandise or stock or whatever. So it is called with different names. So it is called inventory. So then what is happening? Credit supplier. So we are purchasing from credit supplier. So creditor. So bills payable. So it is known as accounts payable. Yeah, it is also known as accounts payable. So what is happening? Inventory is increasing. So inventory is increasing. So creditor is also increasing. So both are increasing. So there is no effect on. So here liabilities rates of creditors will be creditors. They also increase. Okay.
Then received a check from credit customer. Received a check from credit customer. So what is happening here? You are receiving money and it is a customer. So both are assets. So you are receiving money. So you are receiving check. So bank account. So bank balance is increasing. So bank balance is increasing because money is coming in. And debtor is also an asset, right? So debtor is a customer. So he has to pay money. So debtor is also customer, but he is decreasing. Why? Because he given you money. So he's paid you money. So that's why there is no effect on liabilities. Sold goods on credit. When you sell goods on credit, what happens? Stock. So stock. So that is inventory, goods, stock, whatever you call it as. So why I'm telling, because inventory is often used in A levels and all. So goods are often used, it is interchangeably used, and stock is also used. Okay, so anything, it is one and the same thing. It is nothing but the merchandise. Okay, so it is merchandise. So what happens when you sell the merchandise goods, the goods go also. So the goods or inventory we call it as. So we can use the word inventory. So inventory, what is happening to inventory when you sell? When you sell, inventory will go up, right? So inventory will decrease. No, so inventory will decrease. So what will happen? Sold goods on credit. So inventory will decrease. But have you received the money? No, you have not received the money. Then what happens? What you have to receive the money in future. So a person has to pay you back. So one person to whom you have sold, he has to pay you back. So he has to pay. So it increases the receivables. The debtor, or it's called account receivable. Okay. So this is called accounts payable. So this is called accounts receivable. Okay. So accounts receivable. So in A level and all, most of the time we'll be using accounts receivable. So then, sold goods on credit, paid off loan in cash. So what is happening here? Cash is going out. Cash is an asset. Cash is going out. Cash is decreasing. So there is decrease in cash. So paid off loan in cash. So what is happening? Loan is also coming down. So loan is also decreasing because we have paid. Loan decrease. Okay. So that's all. So this is how you have to do. So very simple logical. If you want more problems, if you want me to explain more problems, so please let me know. But don't feel shy even if it is a very silly doubt. Please let me know so that we will discuss. I will explain to you in detail so that you understand the concept. This is very simple concept but very important concept, so that you don't commit errors in the otherwise you will struggle in the future. Like when you do move ahead, you will have to struggle a lot. So please don't do that. Okay, try to understand, and if you have any doubts, even if it is a very silly mistake, don't think that you will look like an idiot. So please ask me. So I will explain to you. So again in different ways. If any problem or anything that you have any specific problem, also please let me know. So we'll discuss it. Okay. So don't worry. The financial statement of Bhavani Traders is given below. So statement of financial position, they have given assets and they have given liabilities. So here see, the assets they have given this side and liabilities they have given this side. So whereas in previous problem, that is chapter 1 before, I wrote liabilities this side, assets this side. So that is another thing, like this is the actual way you have to write. This is assets always you have to write this side and liabilities you have to write this side. So please keep in mind. Okay. So ultimately the figures matter, and even this also matters a lot because this is how we will write. Assets will come this side and liabilities will come this side. On 1st November 2014, the following transactions took place. A check for 3,000 was paid on to a credit supplier. A credit customer paid $500 in cash. A loan for 8,000 which was paid to bank was issued from the limited. A check for 7,000 was paid for additional machine. Prepare the statement of financial position of Bhavani Traders on 1st November 2014. the above transactions are taken place. Prepare the statement of financial position of Bhavani traders after the above transactions are taken place. So how do you do that? So basically you have to analyze what is happening. So on 1st November 24, the following transactions took place. A check for 30,000, 3,000 was paid to a credit supplier. So you have paid a check. So minus 3,000 from this, minus 3,000 from this. Okay. Then a credit customer paid 500 in cash. Credit customer paid 500 in cash. 500. So credit customer paid 500 in cash. So customer, where is customer? Trade receivable is customer. So this will come down. So this will increase. Then a loan for 8,000 which had been paid to bank was received from lenders limited. A loan for 8,000 which was paid into bank. So it is increasing. 8,000. So lenders limited. So lenders limited. Okay. So because it is not for trade payables, it is a loan lenders limited. So how much it is? 8,000. So then was received from lenders. Check for 7,000 was paid for an additional machine. Check was paid for additional machine. So machine is coming in. How much? Worth 7,000. Machine is coming in, and cash money is going out from bank. Money is going out from bank. So that is 7,000. So what will be the effect of this? So this will become 5,000. So this will be 35,000. This will be same. This will become 5,000. This will be 8,000. So lenders limited one adding will come. So machinery, this will become 19 plus 7, 26,000. So this will be 6,000 itself. This will be 4,900. So this will become 2,500. So this will become 2,500. So this will become 10,100 plus 8,000 plus 1,000 minus 3,000. 7,000 10,100 minus 3,000 plus 1,000. So it will be 8,000. So the cash at bank will become 8,000. So cash in hand will become 500. So then this total will change. This total will be 40,000. So this side also total will be 40,000. Okay. So this is how it is. So this is a very simple problem. Okay then. So this chapter is done. So this is C1, P5. Okay. So we'll see in the next class. Let's catch up in the next class with the next lesson. Till then, keep practicing, keep learning. So if you have any doubts, please let me know. So we can always discuss. Even if it is a very silly doubt, please let me know. So just write a comment in the section. So I will be very happy to help you. So we are here to help you. So please learn and please do good in your life. So all the best. Okay.
Dear students, since we already discussed the theoretical aspects in the previous lesson, so chapter 1 IGCSE, so we will do some practical questions so that the concepts are clear. Okay. So complete the following table. What office machinery on credit from the ASRs limited. So what is happening here? What we are supposed to do? Complete the following table. Accounts to be debited, account to be credited. Bought office furniture or bought office machinery on credit from the ISAC Limited. So which account will be debited? Office machinery account will be debited. Why office machinery account will be debited? Because machinery is coming in, right? So machinery, office machinery is an asset. So what is the rule? Debit what comes in? Okay, so debit what comes in. That is the rule, right? So what is the rule? Debit what comes in? Debit what is received or debit what is received. So machinery is when you buy office machinery, obviously office machinery is received. So office machinery. Okay, office machinery is received. On credit from DSRs. See, this is how you have to break the transaction for you to understand. Okay, so break the transaction for you to understand. So the concept is clear. From DSRs. So who is DSR? DSR is the person who is giving machine, right? So he is giving machine. He is giving machine to the business. So DSR should be credited. ISAC. ISAC Limited will be credited. The proprietor paid a creditor C. Jones from his private funds. So what's happening here? So proprietor paid a creditor C. Jones from his private funds. So he's paying from owner is paying out of his private funds. So money is going out. But who is receiving? Creditor. Creditor Mr. C. Jones. Creditor C. Jones. Okay. Creditor C. Jones is receiving. So C. Jones account will be debited. Why he is receiving? Okay. C. Jones account will be debited because he is receiving. So he is receiving. No? So C. Jones is receiving. So who is the giver? So giver is the owner. So it is the capital owner. Okay. So capital. When the owner gives, we should never write the owner's name, but we have to write it as capital. So we have to write it as capital. So because it is proprietor who is paying the money. So a debtor N Fox paid us in cash. So what is happening? Cash is coming. Cash is coming in. What is received? Cash is being received. Cash is being received. So who is giving? Fox is the giving person who is giving. So N Fox is the person who is giving. So N Fox will be credited because he is the giving. He is the person who is giving. So then repaid part of loan by Exeter by check. So what is happening here? Money is going out of bank. Repaid part of loan by Exeter by check. So money is going out of bank. So what you have to do? Bank account will be created. And paid part of loan from P Exeter by check. So we have paid P Exeter. So who is P Exeter? What is he doing? He is receiving. So he is receiving. Debit the person who is receiving. Debit the person who is receiving. So it is P Exeter. So return some office machinery to DISAs. So exactly reverse it. So office machinery to DISAs. So DISAs will be debited because he is receiving now. Earlier he had given, now he will be receiving. So DISAs will be
debited and machinery will be debited. Why machinery is going out, is giving, so that is given out, given away. So a debtor only pays us by check. So what is happening? Money is coming into bank. Money is coming into bank, and who is giving? Lending is giving. And lending is giving. So he is the person who is giving. So bank we are receiving. So what is received? Money is being received in bank. Bought van by cash. So what is happening? Van is coming in. Van is being received and cash is being given. So remember the rules, accounting rules. So and then do the problem. So now the concept should be clear to you. So we'll catch up, or you can do this as a homework. So you can do this as homework. So suppose you have any doubts, you can ask. You can put a query in the comments to this class in the video. So I will definitely explain this. So you can have a look at this question. So here, complete the following table: accounts to be debited, accounts to be credited, bought login for cash, paid or delayed by check, repaid loan by cash, paid salary, repaid bill cash by cash, sold login for cash, bought office machinery and paid from Ultra Limited, a debtor LE pays us by cash, a debtor J Cross pays us by check, proprietor puts a further amount into the business by check, a loan of 200 in cash is received from a loan, so paid a creditor did not the cash. So try this question on your own. So don't try to copy. So please try understand, because this is very important concept. Otherwise, going further you will struggle to understand. So ultimately you may not understand and you will face difficulties. So please try to understand. So and do the problem. And if you have any doubts, please let me know as a comment in the comment section. Till then, have a good day.
TVA-ului, adică 33% reducere la cașcaval ambalat și hrană pentru animale și de 2 ori valoarea TVA-ului, adică 42% reducere la bagaje. Detalii în regulamentul disponibil pe carrefour.ro. Carrefour.
नसीब से मिला जो ये तेरा साथ है हर पल मेरे होठों पे तेरी ही बात है मेरी जान चली जाए है तू जो मुड़ के देखे है तुझे से कटके गिरे तेरे छत पे आके है पागल पागल है थोड़े बादल बादल है दोनों खुल के बरसे भीगे आसरा अखियां तेरी मेरे दिल पे वार करे तेरी ये जानिए तुझे ना पता जानिए ऐसा नशा जानिए मेरे दिल को पार करे सूरा खुदाया होश मेरा कैसे तू उड़ाए खुदाया जिक्र तेरा होठों पे क्यों आए वो सजना दे वो सजना दे खुद से बिछड़ना मुझको अच्छा लगा है तुझ में बिखरना मुझको सच्चा लगा है अधूरा था मैं अब पूरा हुआ जब से मेरा हो गया मनमानियों से है नजारे क्या दरमिया है ये हमारे दिल कागज का एक पंछी तू अंबर सराय तुझे जो देखे ये फूल उड़ ही जाए बादल जैसे बस तुमसे प्यार करे तेरी ये जानिए तुझे ना पता जानिए ऐसा नशा जानिए मेरे दिल पे बात करे तुमसे मिला पहली दफा मिलके लगा तूने छुआ सपनों में मरहम मरहम दिल पे लगा जा तेरा देश ये दिल की पतंग को काटे है तुझी सी गिरे तेरी छत पे आके आए हमने तुझसे दिल लगाए जो उर्दू ना भी आए तो शख्स शायरी करने लगता है कि कोई इतना खूबसूरत कोई इतना खूबसूरत कोई इतना खूबसूरत कैसे हो सकता है बादल बादल है थोड़े बादल बादल है भीगे बरसे भीगे आसरा अखियां तेरी मेरे दिल पे वार करे तेरी जानिए तुझे ना पता जानिए ऐसा नशा जानिए मेरे दिल को पार करे जो भी तेरा साथ है तेरे होठों पे तेरी बात जब से मेरा हो गया जो तुम मेरे हो तो मैं जीना नहीं चाहूं दुनिया में तुझको ही बस देख कर बोले मुझको ही मेरी नजर तुझको शायद नहीं है खबर तुझको जीते हैं हम किस देखो ना जुल्फों से कैसे जुल्फों से तेरी चुपती प्यारी प्यारी सी मुस्कान है और नजरें झुकी और नजरें उठी तो मैं क्या ही करूं बड़े पार मैं सारी रात यादें भरता यादों में मरता माने ना मेरी मन मेरा थोड़ी थोड़ी होश मदहोशी सी है नींद बेहोशी सी है जाने कुछ भी ना मेरा और आओगे ऐसे आओगे तेरी मेरी क्या राहें उजड़ी है और राहों में जो तुम आए कभी हम तो प्यार से ही मर जाएंगे आसां था क्या रहना यूं कहा आज नादा इस दिल की बेताबी रुकी हुई है रुकी हुई है नाराज़ी है ताज़ी पूछे तू कि तुझमें मैं क्या देखता हूँ जब चारों तरफ आज कितने ही सारे सारे हैं जाने ना तू खुद को यूं ना जाने क्यों नजरों से मेरी देखो ना खुद को जरा तेरे होठों को जिनसे रखती मेरे प्यारे प्यारे नाम है और दिल का तेरे और दिल का तेरे अब मैं क्या ही कहूँ क्या बात है इतनी कोशिशों में शाम जो खुशी है नाराज़ी है ताज़ी पर छुपी हुई है छुपी हुई है ओ नाराज़ी है ताज़ी जुड़े जो तेरे नाम से तो टूट ऐसे आओगे तेरी मेरी क्या है राहें उजड़ी है और राहों में जो तुम आए कभी हम तो प्यार से मर जाएंगे आशिक दिल तेरा पुराना है ये दीवाना दीवाना समझेगा देखो ना जुल्फों से कैसे जुल्फों से तेरी चुपती प्यारी प्यारी सी मुस्कान है और नजरें झुकी और नजरें उठी तो मैं क्या ही करूं पर मैं कभी चुप चुप रहे कभी गाया ये करे बिन पूछे तेरी तारीफें सुनाया ये करे है कोई हकीकत तू या कोई फसाना है कुछ जाने तू तो इतना कि ये तेरा दीवाना है चाहे भी बादल तो चाहे फिर भी तुम्हें क्या पता तुमको मांगू ना कुछ और जो तुम मेरे किस्मत का आए ना तेरी याद को आए ना तेरी याद को किताबों के इन धूल भरे पन्नों में तू क्या ढूंढती
जैसे बजती हो जब से मैंने तुझको देखा नया रंग प्यारी सी है ज्यादा प्यार से कम इससे ज्यादा कैसे कहूँ मैं समझाऊं मैं तो दिल समझने पाता मांगे तेरी तेरिया
किस्मत का मानस फासले सारा जाने तो थोड़ा सा तुमने बेकारा मेरा है तुझसे ऐसे ना जाऊंगा ऐसे ना जाऊंगा जो ये है गाए सारी जैसे तुझसे बात तेरी याद सताए सांस आके रुके मैं तुझको कितना चाहता हूँ कि तू कभी सोच ना सके तेरे लिए दुनिया छोड़ दी है तुझ पे ही सांस आके रुके मैं तुझको कितना चाहता हूँ कि तू कभी सोच ना